side?
Well, I don't see an agenda to address that in either political party. It's been concerning to a lot of members of Congress because to get our country in a sustainable fiscal situation, we need to make long-term reforms to our mandatory spending programs, such as veterans benefits or Social Security or Medicare, and healthcare costs drive a lot of that non-sustainable finance. But that can only be done, on a bipartisan basis. And it's been attempted on and off for 40 years with really only one material change, which was Ronald Reagan's work with then Democratic Speaker Tip O'Neill to reform Social Security back in '83 and '84. But it's that kind of targeted bipartisan approach I think we need. And all we're doing is trying to lower the growth rate of those programs over a long term because we have the best economy, the best rule of law system, the best litigation and legal court system in the world, and we have the best banking and capital market system in the world. Those are all indicia of a good reserve currency, but you also want global confidence and domestic confidence in a long-term sustainable fiscal situation.
Speaking of confidence, are you confident that the government will not shut down? We're facing a government shutdown September 30th, and you'll be back in D.C. for about 3 weeks.
Right.
That's it, to really hammer this out.
Well, Anne-Marie, I am confident that we won't have a government shutdown because we're just a few weeks away from a national election, and I don't think that benefits anybody running for re-election. So I think we will navigate the need for a continuing resolution to get fiscal 25 spending moved to beyond the election. And in the House, we've gotten 70% of funding passed and across the House floor. Over in the Senate, they've not gotten across the Senate floor spending, so we're going to be confronted with a CR, but I do think we'll get that done before September 30th.
I guess my question is then, is this a CR that's clean? Because Schumer put out a Dear Colleague letter last night talking about the fact that there can't be any poison pills in it. Will it be a clean CR that Republicans and Democrats can agree to as just basically funding the government until the end of the year?
That may be ultimately what happens, but I think Speaker Johnson's proposed that we do a clean CR with 3 additions. One, some disaster money that's needed, some 2 Virginia-class submarines be added into it, and then finally the SAVE Act, which would be a Republican proposal, would pass the House with bipartisan support, reminding states that only citizens can vote in federal elections and giving the states some guidance on how to make sure that's the case. With nearly 10 million people in the country, a huge majority of which are not citizens, audits have found some non-citizens attempting to vote in federal elections. It's a big issue. When I was home in Arkansas just the last few weeks, it came up time and time again at events that I went to. So people are concerned about that. Speaker Johnson proposes that we put that bill, the SAVE Act, attached to the CR.
Yeah, it doesn't look like the Senate's willing to take that up. Given the fact that after this it's going to be all about politics, what are you and your colleagues discussing when you look down ballot? The fact that Democrats are just absolutely trouncing Republicans when it comes to fundraising, especially in the House.
Well, our candidates, both our challengers and our incumbents, had excellent hard money fundraising up until the summer. So they were leading their Democratic opponents across the board through the summer fundraising. So I think that first 18 months of the cycle, I think our incumbents and our challengers did very, very well. Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
You were talking about the deficit and how that's your biggest concern, more than, say, countries that are looking for alternatives to the dollar. Do you think that this country can afford a 15% corporate tax rate, given the fact that already we're kind of struggling to bridge that gap?
Well, look, when we come into session in the 119th Congress next year, we've got some real challenges. We've got 2 big, I think, fiscal red blinking lights on the dashboard of the Congress. First, Tax Cuts and Jobs Act rates and policies are going to expire during the year. And secondly, we're coming into yet another Congress with a $2 trillion annualized deficit forecast. So Congress has hard work, and Jason Smith, who's our Ways and Means Committee chair, has got the point on how do we preserve growth in this environment and how do we set rates that reflect the growth that we need, the faster economic growth and productivity that we want, fairness for small businesses, but recognize that we're confronting this big deficit.
Do you think that it's appropriate for the Federal Reserve to lower rates to make the deficit more affordable in sort of a policy shift, even if that means that inflation runs a little bit hotter?
I don't think that's the Fed's job. I think the Fed's job is price stability. I don't think the Fed's job is to do that. It has in the past, since 1913. We've had the Fed and the Treasury work in cahoots to lower borrowing costs during World War II, for example. But I think in a modern context, the Fed's principal mission is price stability.
We know you've got places to be. One of those places this morning is over at Barclays at the Global Financial Services Conference. Walk us through what should be top of the regulatory agenda in the next term, for the next 4 years maybe, headed up by, say, Donald Trump in the White House, and maybe you at the head of the Financial Services Committee.
Yeah. Well, I think we want to have access to capital as the number one issue. We want a very successful continuation of our capital market system, raising capital through the capital markets, but also we want a banking system that has affordable credit and accessible credit. And part of that is over the last decade or so since the financial crisis, we just have added on more regulatory costs in both the portfolio commercial banking sector and in the capital market sector that I don't believe improve safety and soundness and are a detriment to more competition in accessing capital. And so I think that's the principal mission.
We've got a lot to talk about. I know you've got to run, but it's good to see you, sir.
Great to
here
see
in New
you,
York City.
Thanks
Thank you very much. Thank you. French Hill there, the congressman from Arkansas on the regulatory agenda and the push on the deficit. And the push on the deficit is something we do not hear on a campaign trail in any way, shape or form.
It's not popular to pay your bills. It's not popular to pay your bills at the expense of programs that you really like or having to pay more. And that's really the challenge. And it's the challenge on both sides. And at a certain point, though, the rubber meets the road.
Coming up on this program, more on that front and this. Steve Englander of Standard Chartered saying the appetite for risk can make a comeback. More on the FX market in just a moment. On the S&P 500, equities making a comeback, up by 0.75% from New York. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Four-day slide on the S&P 500. Equities bounced back 0.8% on the S&P. On the Nasdaq 100, positive by almost 1 full percentage point. On a Russell, the small caps lag up by 0.2%. Last week, the biggest one-week loss on the S&P 500 going back to the bank stress, the bank failures of March 2023. Switch on the board and turn the page and get to the bond market and just check out the difference between a 2-year and a 10-year. Both up by 4 to 5 basis points, both maturities this morning. The 2-year yielding 369.57, the 10-year at 375.32. This yield curve is normalizing. The difference is positive, and we closed there for the first time in about 2 years on Friday's session.
The answer, or really the main question that people have been asking has been, what does this mean? Is this actually a sign of some impending doom? Because usually when a curve disinverts after a long period of inversion, that typically means recession. Or is this a sign that people believe that this Federal Reserve will cut rates enough to stave off a recession? A lot of people leaning into that idea. We'll see.
We're at 550. Market pricing suggesting we're coming back down to something in the 3s. Priya Misra of JP Morgan Asset Management has sat around this table a few times and suggested you don't need a recession for that. That is just back towards the lower end of estimates of neutral at the Federal Reserve.
This to me, and I was quite passionate about this at the end of last week, and partly because
just a little bit passionate.
I can bring it back. Don't make me. Don't make me. I will do it. There is this question around whether we are seeing a fundamentally higher neutral rate now post-pandemic than we did pre-pandemic. And it seems like the answer is not necessarily. And people have been adjusting to that view after saying for many, many months, maybe we're looking at a 4% neutral rate, even 5% neutral rate. We don't hear those people talking about that anymore.
Look out for an update on September 18th of the summary of economic projections. The dot plot's going to be one to watch. Let's just park the bond market, turn the page to the commodity market and look at crude. Not so much the move this morning. The levels we're down to now. Low 70s on Brent, high 60s on WTI. 5-day losing streak on WTI crude last week. WTI had a weekly loss of almost 8% on WTI crude. Last week was brutal for commodities, including crude.
Yeah, Jim Reid pointing out that Brent crude oil prices ended the week at their lowest closing level going back to December of 2021, pointing out that essentially this came as OPEC Plus was forced to curtail their increase in production. My question is, how much of this is entirely China? We saw sort of almost on the verge of disinflation over in China. How much is this having to do with Europe and what we're seeing in Germany? And how much is this global and something that also is infecting the United States at a time when people are wondering if the labor market is rolling over? And that is sort of adding to the sort of angst behind the numbers that we saw on Friday.
OPEC right now is just deciding to not add to the barrels. But I think a bigger question is, are they going to have to cut to maintain these prices? You look at what the Vitol CEO, Russell Hardy, had to say to Bloomberg overnight. We are going to see supply. No one in the market is worried about supply in 2025 or 2026. So if you're OPEC and you're looking at that, and you see the United States pumping more than 13 million barrels a day, you're probably a little bit concerned that you actually might have to start cutting into next year.
China, a major piece of this puddle. WTI right now, 68.13. Under surveillance this morning, Apple preparing to roll out the iPhone 16 at an event later on today. The company also expected to reveal major updates to both the Apple Watch and AirPods and set the stage for its new suite of AI tools. The stock is up by, let's call it 0.6% in the pre-market. Lisa, I think this is a big one for the whole AI ecosystem. Demonstrate the use case for the smartphone. How do they convey that in the next 12 hours?
And demonstrate the price tag necessary for that. A lot of people looking at whether Apple increases the prices. Typically, they've tried to keep them the same to bring in a number of customers. If they raise prices and roll out a suite of a phone that will cook your dinner for you and mend your kids' clothes, then I think that you will see sort of a curious action in markets that want to see those margins increase. They want to see prices increase in tandem with that. Key question for me, John, and I think that everybody really wants to know, will Jonathan Ferro decide to upgrade as a result of the upgrades that we get unveiled at 1 p.m. today?
Let's see what we get. I'll give you an answer tomorrow morning.
That will be what everybody's looking for.
I might be.
Really?
I've brought a phone charger to work, so now I'm just constantly charged. So that's like my hack. My technological hack is just to bring the charger everywhere with me.
Okay, hold
just
up.
Plug in the phone.
And there's portable chargers.
Wait, no, pause.
Right?
Just get a power bank.
You've got a portable charger, right? Is that what you do?
Everywhere.
Yeah, there you go.
Okay.
There you go.
Power banks everywhere.
How long do you guys have a charge? Does that just mean that your phone has about 20 minutes before it dies?
No, I think it
What is
lasts a
this?
few hours. It's not that bad.
Is this
It's
an
not that
iPhone
terrible.
7?
You need to plug it in after this show.
Yes,
3
something
hours
like
after
that.
the show.
Are you on your
Do you not get
phone?
charge anxiety on the phone all the time, Bramo? All right, latest story. DirecTV filing a complaint with the FCC against Disney, accusing Disney of failing to negotiate in good faith and engaging in anti-competitive behavior. This coming after DirecTV customers lost access to both ABC and ESPN more than a week ago, and we still haven't addressed this issue. Some people thought it might only last a few days, and here we are.
This is going to be really key to me also. How do some of the antitrust regulators deal with the fact that right now the balance of power has shifted to a lot of these content providers away from cable? How committed are people to preserving old cable the way it used to be versus the new media? And are they going to get more materially involved? What's the actual case that they have on an antitrust level?
I want to know if they really think that Disney is negotiating in bad faith, or if the issue is actually about trying to heat up the rhetoric ahead of Monday Night Football, ahead of a tomorrow really important debate. Do they want their 11 million customers, many of them in San Francisco and New York, be able to see the 49ers and the Jets?
Perfect timing. Perfect timing to really heating up this debate. Let's turn to this story, the latest out of China. China's core inflation cooling to the weakest level in more than 3 years. Core CPI rising just 0.3% in August from a year earlier, boosting the case for stronger stimulus efforts as weak demands puts its annual growth target under pressure. Just go through where we are right now in financial markets. Chinese stocks near 5-year lows. That's the equity market. The commodity market, iron ore, continuing to sell off. The picture for Chinese growth just is not great at the moment. And we spent a lot of time talking about the death, the end of US exceptionalism, not enough talking about what isn't happening abroad. You're not seeing a pickup in Europe, Germany. You're not seeing a pickup in China.
The U.S. is exceptional just simply because it's not as bad as the rest of them, right? I mean, that's sort of part of the story here. The fact that you saw iron ore sink below $90 a ton highlights how maybe China comes in with fiscal stimulus, but it's not going to be boosting their infrastructure in the same kind of way. It's going to be directed in another direction. When I talk to corporate executives in the United States, a lot of them still continue to talk about expansion in China. How long can that continue? At what point does this hinge on Donald Trump being a tariff man or not, and what those tariffs look like? When you ask them, what is your biggest concern for the next year? Without a doubt, every single one of them says the strength of the consumer, both in the U.S. and in China, and what tariffs look like, and how much that really fundamentally changes their strategies is significant.
And the nationalistic undertones picking up with the Chinese consumer over the last few years as well. That one is certainly relevant when it comes to Apple and that launch in the next 12 hours or so. Investors awaiting US CPI on Wednesday after a weaker than expected payrolls report on Friday added fuel to the debate over the size of the Fed's first rate cut. Steve Englander of Standard Chartered writing the following: CPI this week won't come in soft enough to put a 50 basis point rate cut back on the agenda. Once the Fed commentary is digested and the openness to aggressive easing on further evidence of softening is reflected upon, we think risk appetite may well come back. Steve joins us now for more. Steve, welcome back to the program, sir. Let's talk about the quiet period for the Federal Reserve and the last comment we got coming into it from the likes of Governor Waller. What was your big takeaway from that address following payrolls on Friday?
One thing that really struck me was his comment that he thought that the neutral employment growth was 80 to 100,000, pretty much what we had thought in 2018, 2019. And no matter how you construe any sort of moving average, we're not there yet. So he seemed to be far away from concern that you had to do anything extraordinary. He didn't close the door on it. But overall, he seemed to be like a 25 basis point person. And, you can debate what is driving the Fed. Is it the weakness in the employment and the labor market, which, since the previous labor market release, that's been the big driver of all the rates move? Or is it the fact that inflation has come much closer to target? He seemed to be much more on, right now it's inflation coming closer to target, so we can afford to gradually take rates down. But we will pay attention to the labor market in case it really turns over, but it hasn't yet. So I thought he put quite a damper, at least in terms of saying, have the hawks shifted towards the dovish stance? The answer is, probably not.
So, Steve, just to build on that, it sounds like what we hear from Governor Waller then is that he believes the labour market is just normalising. It's cooler, but it's not cool. It's weakened somewhat, but it's not weak. So, Steve, the question I would ask of you is, how do they communicate the next move of the Federal Reserve, given they've all but communicated it will be a rate cut? Do they see that as a mid-cycle adjustment? Do they see that as the beginning of normalisation and going back to, I would say, neutral? What I don't hear is let's get accommodative and let's get accommodative quick. How do you think they communicate that on September 18th?
Well, I think what they're going to emphasize is that they're at the beginning of a rate cycle, and they've all said rate cutting cycle. They've all said that. I think they're going to convey that there's going to be more than one, and there's probably going to be a sequence of them in the near term. What they're not going to do is commit to whether it's 25, 50, or more, and kind of imply that I think the baseline is 25. I also suspect that quite possibly the sort of into projections, by the time you get to the end of next year, they'll sort of be where the market is, mid threes maybe, but not, something that's 2.5 or 2 or something that's really dramatic. And that will show up in their other projections as well, that they're, we're kind of in we're cutting more than in 1996, but the economy is kind of like in 1996. It's doing okay, but because inflation's at target, we can afford to move, to get rates back to neutral.
A lot of what the market's trying to figure out is where the Fed is, as John was pointing out, relative to where markets are pricing. And we were talking about U.S. exceptionalism. And maybe it's not dead, not because the U.S. is doing so wonderfully, but just because the rest of the world isn't really doing so wonderfully. Steve, how much do you think that it is a liability to ignore the ECB later this week, to ignore some of the weakness that we saw in China, some of the weakness that we're seeing in Germany, as a reason to maybe fly in the face of some of the weakness we've seen in the dollar over the past week?
I think the Fed is struggling with the data. We've argued that immigration and undocumented immigration increases the labor supply. And so that distorts to some degree, relative to past comparisons, it distorts, how do you interpret 120,000 jobs or 150,000 jobs versus 5 years ago? It also affects GDP. The numbers are coming in, GDP now is like mid-twos. Is that like, that's pretty good. If you think that there hasn't been a shift in supply, or does that translate into 1.5 like 5 years ago? And so I think that they're not yet ready to reject the numbers, but they're trying to sort out exactly what these numbers mean. And it tells them to go gradually. And so I think it makes it harder for them. There's not a good playbook for when the shocks come from the supply side. And all 99% of what they write is focused on the demand side.
Yeah. Let's just do a scenario analysis and say that the data doesn't change materially between now and September 18th. If the Fed cuts by 25 basis points or by 50 basis points, what's the difference in the market reaction from your view?
The market was trading last week as if it desperately wanted to get a 50, that the 50 would sort of calm it down. And it was almost as if it had the shakes that it needed, that 50. I think at the end of the day, 25 versus 50 doesn't matter much. Also, it's quite possible we have a 50 penciled in for Q1 of next year. If they did it December, or if they did it January as we have, I think the market will be just fine with it. But I think that ultimately what the market needs to see is that the Fed's on a cutting path and that they're cutting towards the 3 handle, and the market will be okay with it. But I think in the short term, you just look at what's priced in. It's still close to, I think 110 basis points over the next 3 meetings. That's not, there's an adjustment there if it's going to be doing 25s, or if the first 2 cuts are going to be 25s, rather than, doing the 50 that the market wants. And I think that's a nut that the market really needs to crack there to be able to deal with. And, obviously today the equity market's doing okay, but we're seeing bonds under pressure, and we're seeing the rest of the world under pressure.
Well, Steve, let's talk about dollar yen and just finish there. I remember when a 1% move on dollar yen used to mean something. I'm not sure if it means anything anymore. We've got a 1% move this morning. Dollar yen's back to just short of 144 at 143.71. What is this FX regime, Steve? How would you describe where we are?
I think the market wavers on the yen. That we think the BOJ could be more aggressive than what the market's pricing in. We think that that they're determined to raise rates. One of the puzzles is why the market sort of thinks that doing another 10 or 20 basis points over 6 months is going to be enough to get the BOJ to wherever they want to go. But I think in the short term, we saw positioning move like long yen and short dollars. And, the Friday sort of discussion was so abrupt, I think, in terms of shaking the market conviction that, some of those positions are getting shut down and pushed closer to neutral. But we still see 130 at the end of next year. We think that this is temporary, and that as the Fed cuts and as the market sees convergence really manifest itself, we will see dollar weakness. They just have to get over the fact that the Fed may not deliver in the short term what the market really wanted.
A few years ago, I might have said, wow, 130, that's a big move, Steve, and maybe we'll see that next week based on some of the price action. Steve, thank you, sir. Steve Englander there of Standard Chartered, appreciate it. Dollar yen with a 1% move, 143.74, a weaker Japanese yen this morning. Let's give an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank. It's the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. The victims were identified as forklift operators. Israel closed the crossing while checking the truck for explosives. Boeing and its largest union say that they've reached a deal to potentially avoid a strike at the troubled U.S. aircraft maker. The offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. That breakthrough came after a marathon bargaining session, but it is too soon to know if workers will go along with that deal. Elon Musk is doubling down on Donald Trump. Musk's pro-Trump America PAC launched ads targeting swing state voters across digital platforms. One YouTube ad says, if you sit this election out, Kamala and the crazies will win. The PAC has spent around $1.4 million on Facebook and Instagram ads alone since May. That's according to data from Meta. It also showed that it was one of the top 10 U.S. political advertisers for Facebook in the week ending September 3rd. That's your brief, John.
Hey, Danny, thank you. Danny will be back in about 30 minutes' time. Up next on the program, the Fed's next move.
I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? 25 is the right number, given that literally everything in this report was better than in July.
Torsten Slok of Apollo, absolutely brilliant to close things out last week going into the weekend. Check out that interview on Bloomberg.com and on the Bloomberg terminal. Torsten Slok of Apollo thinks this economy is still better than okay. From New York, this is Bloomberg.
What about
artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bouncing back from Friday's losses, equities just about positive on the S&P 500. A nice bounce, decent, firmer by 0.7%. Yields are higher too, up 4 basis points on a 10-year, 374.75. And talking about an unwind, a reversal of some of Friday's moves. See the same thing on crude. Crude bouncing back from an ugly week of losses last week. WTI up 0.8% to 68.21. Under surveillance this morning, the Fed's next move.
I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? 25 is the right number, given that literally everything in this report was better than in July. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
Here's the latest. Traders gearing up for a busy week of economic data with attention turning to Wednesday's CPI print ahead of the Fed's decision on September 18th. Nita Richardson of ADP writing CPI measure of inflation from the Bureau of Labor Statistics is the most important indicator of the week. It might influence the size of any Fed rate cut, be it 25 or 50. Bloomberg's contributor, Nita Richardson, joins us now for more. Nita, good morning to you.
Good morning.
It's good to see you. Let's start with the labour market on Friday, then we can shift towards CPI. A word that I think you own. Dynamism. You talked about this. Are we losing dynamism in this labour market?
In a word, yes. Hiring rates are lower now than they were in 2019. And remember that dynamism has been the hallmark of the U.S. labor market, the fact that people are willing to pick up and move to better opportunities. Literally move, they don't actually have to do anymore because of so much remote work. You should see a dynamic churn in the labor market that's healthy. You're not seeing that as much. It's a slower hiring rate. People are staying longer on the job. That could be that there are not better opportunities. It could be that, firms are keeping and motivating people on the job. I think it's more the former. When I talk to companies around the country, they're a little surprised that turnover is so low. And so there's been some tweaks in how they hire to adjust for the fact that people are staying on the job longer.
Just to build on something that you said at the end there, is there some indication you think that we can maintain the current state of things? Because there is a fear, particularly in financial markets, that maybe we go off the deep end sometime soon. How do you think about that?
There's been a lot of talk about whether this is a soft landing or a hard landing, and my argument is it matters where we're landing. And I think we are landing in a different set of labor market conditions that is different from where we left. Dynamism is slower, manufacturing will be a persistent drag on employment, and pay growth is elevated. It's stabilizing at an elevated rate. These are the conditions on the ground. Now, I still think that those conditions are good enough to propel consumer spending and economic growth, but they are different on the ground conditions than where we left.
What's the reference point? Is it 2019?
It would be 2019, in my view, and those months leading into the pandemic. There you saw a manufacturing sector that was shedding jobs, but you saw higher hiring rates. Unemployment was a bit lower. There was more churn in the labor market. It was a little healthier than what we're seeing now.
You talk about soft or hard, a labor market landing is close at hand, and you talk about the destination has changed. And that's why you talk about it's about where we are landing. My question is, what kind of economy is it that you're describing? It sounds to me more stagnant, more not necessarily this inflationary kind of fast growth environment that a lot of people have just been pricing in.
No, we're seeing an elevated wage growth, but not wage growth that's going to trigger another bout of inflation. Wages are actually stabilizing. And you see that across the board, whether you're looking at new hires or people who've been in the job for a very long time or people who've recently switched jobs. The wages are stabilizing, and that's good news for the inflation story. It's not great news for the dynamism story that really propels people to churn and companies to seek out the best talent. We're not seeing that kind of competition in the labor market like we did in 2022, which was extreme, I grant you, but we're not going back there.
You've looked a lot about manufacturing and how basically they've gone negative this year. Wasn't that fiscal spending supposed to help this sector?
But those dollars haven't been met yet, right? So those dollars have not really changed the game in terms of manufacturing, and demand is still sluggish. So you're looking at new orders that were, those numbers that came out recently were lower than expected and lower than where we've been. And then they didn't shine a light on a rebounding manufacturing sector. We're still very far. This economy has tilted into services. So in my view, you have a service sector that is normalizing in terms of a labor market and a manufacturing sector that is weakening. You add those two together and you have a softer labor market.
But if you're saying the money hasn't reached it yet, does that mean potentially you could see manufacturing jobs pick up next year?
It depends. The thing about this type of labor market is it does rely on skilled workers, and vocational talent has been hard to come by. It depends on what kind of skills are needed in those manufacturing jobs, and it depends on whether we as an economy are producing the right skill set for the right jobs that could actually boost that sector, and I think that's an open question. And manufacturing is also dependent on the rest of the world and how the rest of the world is doing, and that is also an open question.
Got 30 seconds to squeeze this in.
Yeah.
Is official data losing credibility?
No, we need our data, especially when we have a Fed that is data dependent. But it is growing. So you have private sector data like ADP showing private sector job gains have slowed. Using that data in collaboration with official data sources is the right path forward.
I was just being kind of setting the stage for an ADP victory lap just then.
I know.
When you...
that was a good job. Neela was very diplomatic.
Trying to do that for Neela.
Yeah,
Neela, thank you. It's good to see you.
Thanks
Thank you very much. Neela Richardson, a Bloomberg TV contributor, and of course joining us from ADP. Coming up on this programme, Ed Yardeni of Yardeni Research, Terry Haynes of Pangea Policy, Bloomberg's Mandeep Singh, and Sonal Desai of Franklin Templeton. With equity futures positive 0.7%, still near session highs from New York. The second hour of Bloomberg Surveillance. Up next.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers. You're watching the close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
We're still in that soft landing cap. There isn't any indication to us that the economy is decelerating at an accelerated pace.
There's a lot of reasons to think that inflation could be stickier, and the Fed is really focused on that.
We really don't see an environment where the economy is going to fall off the cliff.
In the aggregate, the growth data is just not showing signs of a slowdown.
We're still pricing in very much a soft landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So this time last week, we opened up the program, we sat here and said payrolls on Friday will determine the size of the next rate cut of the Federal Reserve on September 18th. The difference between 25 and 50 is whatever payrolls might be. Payrolls dropped, settled absolutely nothing. And here we are waiting for CPI with a belief on the margin that maybe CPI could settle the difference between 25 and 50. Equity futures look like this on the S&P 500. It's a bounce back up by 0.75% following the worst week of the year so far. On the Nasdaq up by 0.8, on a Russell up by 0.2. CPI coming later this week, PPI as well, but there's plenty of events in between. An Apple iPhone launch a little bit later on today, a big debate between Harris and Trump coming up tomorrow, and UMich consumer sentiment, Lisa, on Friday.
And UMich consumer sentiment might actually turn the tide. The reason why, and I want to go back to where you started, this idea that we were hopeful that maybe this jobs report would give us some clarity, and it gave us none. We keep waiting for enough data that Fed officials tell us will determine the difference between a larger or a just sort of measured rate cut in the September 18th meeting. The reality is we're looking for some sort of exit strategy from this confusion, this morass of conflicting data, and we're not getting it. And what does that mean is something that the markets are really struggling with.
We've got a live meeting coming up in a few weeks, and maybe we even get some dissent on that live meeting on the FOMC. Perhaps that dissent comes September 18th.
Oh, potentially we get that dissent, Jonathan. I was looking back last night about that memo put out by Raphael Bostic on September 4th, not too long ago. History shouts to us that loosening monetary policy preemptively is a dangerous gambit. There is still some concern, and I'm sorry, Governor Christopher Waller didn't really give us that definitive answer whether or not it's 25 or 50. Sure, the time has come. But what exactly are they going to do? That remains a question.
Jobless claims on Thursday as well. Last big read on the labour market going into that Fed meeting next week.
You know, I almost forgot about the ECB meeting on Thursday, and I think a lot of people did. I mean, really, like when I was thinking about the particular events this week, I was thinking, okay, what else? And you pointed out, oh yeah, the ECB. And I actually think it might be quite interesting, considering the fact that everyone's kind of written off the ECB as simply following in the footsteps of the Federal Reserve. They have it a lot worse. And let's just put it very starkly. They're facing some real economic weakness that cannot be sugarcoated the way that it can in the United States. That might be one of the more interesting moments where we see what is the response function to both inflationary pressures that haven't fully died, but at the same time, real weakness that is not just the US's, but globally.
I'm really pleased you brought this up. We've talked about this a million times. In Germany, the model is broken, and there's no evidence, any real sign that they've come up with a new one that might be successful anytime soon. Europe, just a derivative of what's taking place in China. China's facing a deflationary spiral. The equity market's near a 5-year low. The commodity market started to get pulled under it as well. what you're seeing in iron ore is hardly a signal that things are robust and great over in China. So if you believe that the US exceptionalism is fading, I think we've got to ask a question. Who's replacing it? Because Europe and China look like they're both in a tough place.
Which is the reason why it's so difficult to understand the moves in the markets. Last week, people were saying that the dollar was pricing in a 50 basis point rate cut by the Federal Reserve. People were saying that bond markets were pricing in a recession in the United States. And Priya Misra came on this show from JP Morgan and said, absolutely not. What it highlights is people expecting the Fed to adjust to the normal that we see currently in terms of inflation. This has to do with the international picture, too. Basically, can you see that kind of dollar weakness, given the fact that the U.S. economy is still the strongest in the world and really continues to outperform some of the laggards, particularly in China and Europe?
Joe Quinlan, though, had an interesting take on this. He's like, is this really exceptionalism, or is it just the fact that the U.S. is the one that's out in front because everyone else is doing so poorly, to your point?
If you are just joining us, welcome to the program. Let's get to the scores. Equity futures right now positive by 0.7%. Talked a little bit about what's happening with crude. Last week, terrible week, down 8% on WTI, bouncing back by 0.9% on crude this morning. In the bond market, yields higher across the curve, up by, let's call it, 4 basis points on a 10-year, 374.56 on a 2-year, 369 up 4 basis points, and the difference between the two, positive. The 2-year, 10-year yield, that slope is positive, Lisa, and closed there for the first time in a couple of years on Friday.
Do you buy that this is a negative signal or a positive signal?
I buy that it's been a negative signal over the last few cycles. Once you get that bull steepener kicking in and start to expect a deep, aggressive cutting cycle from the Federal Reserve, it usually means not great things are happening in the economy.
We've never seen a deep rate cutting cycle from the Federal Reserve without some kind of recession, and everyone's saying this time is different. And that's what I find fascinating. How much can you lead into that because of the post-pandemic realities that have been distortive to a lot of the economic data?
How different are things this time? In the next 60 minutes, the lineup looks like this. Ed Yardeni of Yardeni Research, with stocks looking to rebound ahead of CPI data. Terry Haynes of Pangea Policy on expectations going into the Trump-Harris debate. And Sonal Desai, Franklin Templeton, on why current market pricing of rate cuts is too aggressive. We begin with our top story. Stocks coming off their worst week since March 2023, following Friday's payrolls report. Ed Yardeni of Yardeni Research saying what's happening now is no more than another growth scare that will pass. Once again, we expect that the economy will surprise to the upside. Our assessment of Friday's employment report is that it wasn't as bad as widely believed. Ed joins us now for more. So, Ed, let's go through that quote and just deconstruct things a little bit. One, sure. Why wasn't it as bad as widely believed? And two, where'd you get the confidence that growth will continue to pick up and surprise to the upside in months to come?
Sure. Well, it seems as though everybody ignored the fact that average weekly hours actually increased by 0.3%. So we had that, and then payrolls were up only 0.1, but put it together and you got aggregate weekly hours for the economy at an all-time record high, increasing 0.4%, which is a very solid increase. And it suggests to me that real GDP is still growing somewhere between 2.5% and 3%, because when you look at aggregate weekly hours on a year-over-year basis, they're up 1.1%. So the question is, how do I get real GDP up to the 2.5% to 3% when aggregate hours are increasing by 1.1%? And again, the variable that everybody's ignoring is productivity. Productivity has been really very strong since last year, and I think we're in a productivity growth boom that will boost GDP.
So let's compare that to what's happened in the market, Ed. As you know, a lot of people have got a different view. Equities have sold off, bonds have rallied hard, yields have dropped a lot. Of those two asset classes, which one do you think's too far extended? Which one would you be leaning the other way?
Well, I think the bond yield is getting pretty close to a bottom here. If you look at the peak yield curve spread, so I'm looking ahead already beyond this inversion that we've just seen to how much of an ascent are we going to get in this yield curve. It could be at least 100 to 150 basis points. And so the bond market's discounting lots of rate cuts, and I think that reflects a misleading view that the economy is not resilient after all, and that we're finally going to have a recession, and that's just not my opinion. It looks to me as though the economy is going to be particularly strong this month when we look at August data for personal income and personal consumption. That looks like it's going to be a very strong number, as does industrial production, which we're likely to see some offset to the auto drop that we saw in July. The auto production dropped significantly in July, which probably just was a seasonal aberration. So you put it all together, and I think we're going to get some pretty good economic indicators here. I think the stock market has had another carry trade hissy fit, as we saw in early August. And that's because the Bank of Japan has announced that they are still on course to raise interest rates. And so the weak employment numbers, perversely, you would think that the weak employment numbers would make the stock market go up. Why? Because the Fed's going to do 50 instead of 25. And that kind of thought really unwound the carry trade once again. And I think that's why the stock market was so weak last week.
And let's pick up on that point. There's a lot to unpack there with the yen carry trade. Mike Wilson over at Morgan Stanley talking about how there's still a lot more to go in terms of that trade unwinding. Do you agree?
Well, I think that view is too pessimistic. I think the carry traders got the message in August, got it again on Friday. I think a lot of it has, in fact, been unwound. But I do agree that if the Fed goes for 50 at September 18th, there'll be more carry trade to unwind. So you would think with a bigger than expected drop, or instead of 25, 50, I guess 50 is increasingly expected. Well, if that were to happen, I think you'd get probably another round of carry trade in a difficult market, but I think they're going to go for 25.
Well, hold on a second. This is actually fascinating, especially because you were talking just a couple months ago about how if the Fed were to cut rates, that would turbocharge equity markets to an unhealthy degree and could create another bubble. And yet, from the technical setup right now, actually, an outsized rate cut by the Federal Reserve would actually depress stock valuations. So can you pair these two ideas?
Oh, yeah. Time is money. What's changed what's changed my view is I didn't see the carry trade unwind coming. However, if you look at a chart of the NASDAQ versus the yen, it's pretty clear that there's been a very strong inverse relationship. A strong yen caused by this differential in monetary policies is bad for the NASDAQ because it unwinds the carry trade. So that's what's really changed in my thinking, but the carry trade will unwind, and we're going to be left with somewhat lower interest rates, and that could very well lead to a very strong year-end rally. So I think lower interest rates are still bullish for the stock market, and could very well give us something that, believe it or not, looks like a melt-up by year-end.
Ed, you also talk about after November 5th. That you're going to see the S&P 500 resume its climb to new highs, remain choppy through November 5th. Are you seeing new highs regardless of who is elected president?
Well, the underlying assumption in my forecast on that is that the big winner on November 5th will be gridlock. If we get a Democratic sweep or a Republican sweep, I'm going to have to change my mind pretty quickly, and I think the market's not going to welcome that at all, because I think both candidates basically have one thing in common, and that is they don't really care about the deficit. And one way or the other, whether it's a Democratic sweep or a Republican sweep, that would imply a much bigger deficit, which I think then could really unravel this bond rally pretty quickly.
Ed, we've got to pick up on that. Are you saying the bond vigilantes make a trip over from the UK and France and have a little visit to the US?
They could very well. They actually, last time we saw them was last summer, August, September, October, when we went from 4.25% to 5% in a heartbeat. And that was because of concerns about all the supply of treasuries. But Janet Yellen came up with a clever trick, which is to finance more in the bill market, less in the bond market. But you can only play that game, I think, once. I don't think it'll work again if, in fact, we get a sweep of one party or the other.
Ed, thank you, sir. Ed Giardini of Giardini Research on the bond market. Drum roll, supply.
Okay, $58 billion of 3-year notes coming tomorrow. We've got $39 billion of 10-year notes on Wednesday and $22 billion of 30-year notes being sold on Thursday. 1 p.m., all the auctions take place. I'm particularly interested, as I usually am, in the longer end, just in terms of how many people come out and at what point this sort of balancing out of the yield curve gets challenged, not by the front end, not by the rate cutting assumptions, but by some of the deficit worries that we keep hearing percolate out, even though they don't seem to come to the fore when these auctions come to the table.
That's Treasury supply. We've had a ton ton of credit supply over the last week as well. Last week, massive week for corporate debt issuance. Let's get you up to speed on the latest elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Former ECB President Mario Draghi says the EU can't be competitive unless it commits to much larger spending. The ECB had tasked Draghi with building this report, and he concluded that the region needs to spend as much as 800 billion euros extra a year, a level not seen in more than 50 years, and issue regular common bonds. He wrote that unless Europe becomes more productive, it won't become a leader in technology, a beacon of climate responsibility, nor an independent player on the world stage. Kamala Harris and Donald Trump are getting ready for their first, and for now, only debate tomorrow night in Philadelphia. And the race is airtight with just 57 days until the election. The latest New York Times Siena College poll has Trump in the lead over Harris among registered voters by just 1 percentage point, 48% to 47%. Following the debate, Harris plans to travel to key battleground states, including North Carolina, on Thursday. Big Lots has filed for bankruptcy protection. It's planning to sell its ongoing assets and ongoing business in a court-supervised process. The discount retailer agreed to sell the business to PE investor Nexus Capital unless a higher bidder emerges. Big Lots has around 1,400 stores and employs over 30,000 people and has suffered from declining sales for years now. That's your Bloomberg brief. John.
Brutal. Danny, more from Danny in about 30 minutes. Thank you. Up next on the program, momentum shifting down the ballot.
Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
We'll pick up on that conversation in just a moment. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks positive this Monday morning, up 0.75% on the S&P 500. In the bond market, Treasuries down, yields up 4 basis points on a 10-year, 3.7475. Under surveillance this morning, momentum shifting down the ballot.
Both our challengers and our incumbents had excellent hard money fundraising up until the summer. So they were leading their Democratic opponents across the board through the summer fundraising. Democrats have had some momentum in the last few weeks to catch up, but now the rubber's hitting the road. And I think we've got adequate funding in the House to hold the House, pick up seats, and I feel optimistic about the Senate as well.
So here's the latest. Donald Trump and Kamala Harris set to face off in their one and only scheduled debate tomorrow evening. The latest polling showing Trump regaining a 1-point edge over Harris nationally. Terry Haynes of Pangea Policy writing, the likeliest result of Tuesday night's debate is Harris will be perceived to win by demonstrating fitness to lead. The Harris wins result would strengthen our view that Harris is 60% likely to win in November. Terry joins us now for more. So Terry, let's pick up on that comment, sir. Where does that advantage come from?
The Harris advantage or the Trump advantage, Sean?
The Harris advantage that you say she has going into tomorrow and will likely retain coming out the other side.
Oh, I think it's two things. One, you have both campaigns engaging in what the Kennedys used to call underdoggery right now. The idea that they're the underdogs, they'll come from behind, making points on those regards. I think that Harris needs to meet or exceed expectations, and there's a lot of uncertainty about who she is, what she stands for, what she's like, frankly, and that can only be answered on a large national stage. If she does reasonably well on that stage, I think people come away with the idea that she's a plausible president, and that acts, I think, as a sort of magnet, helping things in her direction by and large. And of course, there's also a lot of press kind of rooting for her too.
Terry, in the New York Times poll over the weekend, it said more than 60% of likely voters said the next president should represent a major change from Biden, but only 25% that the vice president represented that change. 53% said Trump did. So if people are, in what this poll is showing, fed up with the Biden administration, why do you think she can still win?
Well, the Times and CNN ought to be asking people if the biggest change is the one that they might like, because there's not a lot of correlation between those two in the poll. Why do I think she can still win? Because firstly, they're neck and neck. Secondly, because I think her theory of the case on how to win is better than Trump's. What Harris has done is consolidated Democrats and is reaching out to independent and undecided voters using social issues and, frankly, Trump loathing. What Trump thinks, by comparison, is in a very swing state sort of strategy, is if I can get 100% of my own base out, which is not all the Republicans, it's his own base, what I can do is I can overwhelm Harris voters and Harris enthusiasm. I don't see that happening for a bunch of reasons, not least of which is that Trump's base isn't the whole party. The establishment party is now pushing against him, and he's not making a convincing case to undecideds, I think.
These individuals have never debated before. Trump, I believe this is his 7th presidential debate. What does she need to do to create a viral moment, kind of like she did with Mike Pence back in the VP debate, given the fact that the mics will be muted and she can't say something like, "Excuse me, I'm talking"?
Right. No, I think that's a very smart question. If I were her, I wouldn't go for viral moments. If I were her, I would be going for kind of prosecuting the case. What she will say is, not only will she be interested in kind of establishing her own bona fides, turning the page. Her great siren song right now is turning the page from the last decade, which not only includes Trump, but Biden, I should point out, as well as saying the words convicted felon as much as possible. And then, frankly, pointing out that the establishment of the Republican Party also isn't against Trump. So the cumulative impact of what she wants to do is establish herself as a safe pair of hands, as somebody that can be trusted, as somebody that will do as a president. And
Terry, the establishment Republicans have been against Trump for years now.
Yeah, that's true. But at the same time, it is only now going to start becoming apparent that, for example, you have the last 2 Republican vice presidents against Trump. You have Bush 43, the last Republican president before Trump, not making an endorsement. You've got half the Trump cabinet against him. That stuff starts to weigh on people, not least because the signal it sends to undecided voters, particularly those who trend Republican, is it's okay. We give you permission to not be for this guy.
You talk to a lot of clients who are trying to get clarity on policy, which is a fool's errand right now because a lot of the policy that we're hearing is sort of a vibe. And a lot of people say, especially in the industries that are relevant, that it's just talk, it's a rhetoric, it's a starting point. How do you sort of help your clients navigate rhetoric that a lot of people, we just heard French Hill, congressman from Arkansas, talk about how the talking about it being a tariff man by Donald Trump was just a starting point for negotiations, not actual policy. How do you advise your clients?
Well, firstly, by agreeing with them on that. Secondly, I commend to everyone Congressman Hill's interview, an absolute top-tier member. And by the way, I thought he undermined the president's case pretty subtly, but effectively on a lot of those things. Thirdly, by telling them that it's not about the president, it's about the president plus Congress. And the base case today, regardless of whether Trump or Harris become president, is that you've got a split Republican Congress again. So what you're going to end up with is a lot more of the remixed status quo. And, you know, I differ with Edgar Denny a little bit in the last segment, because regardless of whether or not there's a Republican or Democratic sweep or there's a mixed Congress, what you're going to end up with is still increases in fiscal debt and deficits. So that's not going to change.
That said, with tariffs, that's something that unilaterally can be done by a president. And it's the reason why people, in particular in business, are really focused on whether that's a starting point for negotiations with China or something actually real. How do you decipher?
I consider tariffs a bluff for a lot of reasons. One is that, you know, I'll agree with Congressman Hill that that you know it's a guy having fun and talking. Secondly, the last thing Trump is going to want to do if he wants to increase economic growth and productivity is impose tariffs way before there's even a chance at a tax deal. Back in 2017, you'll recall that it took Congress a solid year, to come up with the 2017 tax law. If he's talking about imposing tariffs unilaterally from day one or close to day one, among other things, what he's going to end up with is a negative street reaction and a negative economic reaction for almost a solid year before those before that tax relief comes. And frankly, I doubt, unless it's a Republican sweep, which I give about 20% today, you know, the chances for tax extension is zero. So because Democrats don't want it. So, you know, I doubt Trump is going to tank the economy.
Terry, thank you, sir. Terry Haynes there of Pangea Policy. If you're an investor right now, the one thing that would make me really nervous is how big the gap might be between how they're campaigning and how they might govern.
I couldn't agree more. What are we going to get from either of them if everyone's saying that what they say is not really what they mean?
Big issue. Coming up on this program, Apple getting ready to unveil its newest iPhone, plus major changes to the watch and AirPods. Mandeep Singh of Bloomberg Intelligence up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Equities on the S&P 500, a lift here of 0.8%. On the Nasdaq 100, a rally, a pickup of 1 full percentage point after a big weekly loss last week on a 4-day slide on the S&P 500. The worst week of the year so far. In fact, the biggest weekly loss going back to the bank stress of March 2023. That's how bad last week was. In the bond market, yields were aggressively lower. Now they're a little bit higher across the curve. 2-year, 10-year, 30-year. Here's the shape of the curve right now. Up 5 basis points on a 2-year, up 4 on 10s. We're looking at 369 versus 375. And we have a yield curve that is slowly and then quickly normalizing.
I do wonder how much this was a growth scare last week. This is what people have been sort of talking about in a lot of these notes, or whether it was just a carry trade unwind, the way that Ed Yardeni was talking about. We didn't necessarily feel the violent fear in markets last week. Let's just be real clear. It sort of seemed like a light trading week, and people said September usually goes down, and oh, by the way, you're going to have Fed rate cuts, so let's buy bonds, let's sell stocks, and think about what the logistics are later.
The hope was certainly for something more decisive, but just to look at the so-called totality of the data, just last week, ISM services was okay, jobless claims was okay, unemployment came back down to 4.2%. It's why people like Torsten Slok of Apollo are making a case that things are okay.
I guess that the bigger picture question, and this is something that I thought that Priya Misra did a fantastic job talking about, how much is the Fed's move in response to true weakness, and how much is it normalizing at a time where inflation is no longer the preeminent concern? This is the reason why I think CPI could be more interesting on Wednesday than a lot of people gave it credence for, simply because if inflation is truly not a risk, what is the argument for the Fed to keep rates where they are, given the fact that regardless of the totality of data, the one message that you're getting is what Neela Richardson was saying, that the dynamism has gone down and you have seen a real slowdown in the labor market.
Neil Dutta, Renmac, 8:30 Eastern Time, so 60 minutes from now. Don't miss this conversation. He put out a big piece on LinkedIn over the weekend, and this was the quote that jumped out for us here at Bloomberg. I'm seeing a lot of wildly optimistic takes out there. Almost feels like people are allowing a political narrative to cloud their analysis of the data. The fact is conditions are getting worse, not better. Goes on to say, there will be a time to be bullish. I'm not sure now is the time. The Fed should go 50 when they can, not when they must.
So putting the political aspect aside, Neil, welcome. Because at a certain point, this is what a lot of people are seeing, is that you are seeing deterioration in the labor market that you can't sugarcoat. The question is, and I think Neela put this brilliantly, this idea of where's the end point? We're talking about some sort of landing, correct, but where? And that's, I think, the difference that people are trying to parse through with how many rate cuts they're pricing in. Are you talking about a real recession? Are you just talking about a bout of weakness? Is this back to 2019? That's what needs to get determined.
Speaking of weakness, the dollar has been weaker. It's stronger this morning against the bulk of G10, with the exception of the Canadian currency. The euro's down to 110.39. Dollar yen, with a sizable move, it's close to 144, 143.75. I joked about this with Steve Englander of Standard Chartered early this morning. 1% moves on dollar yen used to mean something. It would mean something had happened, and now we're just looking at this associated with the risk bounce that we're seeing elsewhere in equities.
Yeah, I'm so glad you brought that up because we've seen volatility that has been unprecedented, not just in currency moves, but also in Fed funds futures last week. Unprecedented moves in terms of probability. When it comes to the yen, this is a twofold story. On one hand, you have this question of just how much the Fed can actually cut rates. And then in Japan, you did see GDP revised lower. This sort of flies in the face of their ability to raise rates. Some people might say everybody else quickly came back and said they still are going to raise rates later this fall. Nonetheless, it sort of challenges this idea that Japan can completely diverge and continue on its tightening cycle.
Dollar yen, 143.73. Under surveillance this morning, some top stories for you. Treasury Secretary Janet Yellen saying the U.S. economy has reached a soft landing even as job growth weakened. Speaking to Bloomberg's David Gura on Saturday, Yellen highlighting falling inflation and rising wages, saying she sees no red lights flashing for the U.S. financial system. Now, is this Janet Yellen the economist or Janet Yellen the politician?
Well, she is a labor market economist, right? And she says she does want to monitor any downside risk in the labor economy. But of course, this is highly political going into the November election. And many on the other side would just take criticism with the fact that she's saying she's not seeing any red lights because she's also the individual that said inflation was transitory.
You know, this argument about some of the commentary about a benign outcome for the economy being political, we heard that in Neil Dutta's commentary. Sure. We've heard it from others as well, talking about Janet Yellen. And even we've heard about this with Claudia Sahm, and maybe that she's not saying that her rule was triggered because of that. And I will just say that when you look at all of the commentary, you start to analyze it piece by piece. Nobody, I cannot think of one person who's saying that the economy is falling into recession. Deep recession right now. Can you think of one person other than Andrew Hollenhorst who says that the risk of recession is increasing? Very few people are saying that. It's a question of where we land. Now, Janet Yellen, yes, 100%. She's completely political in every which way. No doubt about that. But it is complicating the totality of data, if you want to go there, to sort of talk about the political angle. It just complicates what you're seeing across the board, which is everyone's saying things are slowing down, period, full stop.
I remember asking someone about what it would take to be a good central banker, and they gave me one word: lie. And I often think about central bankers, and I think they're well aware that they have the ability to influence the events they anticipate. If they actually came out and started to talk about the labour market and the downside risks that they perceive at the moment, I think you'd be a lot more worried about the future. So they sort of have to pull back, and I think Janet Yellen's been schooled in that in the Federal Reserve, hasn't she? Over many decades of that institution.
If the Federal Reserve came out and said they were worried about downside risks.
Well, they say that anyway, but if they said that we think we're going into recession, you'd be in one tomorrow.
Well, do you think so?
Oh, immediately. Think about how people would change their behaviour.
You think so, even if they cut by 100 basis points?
What would happen to markets tomorrow? They come out and say recession tomorrow.
Well, if they said recession tomorrow, and then if that's the reason why we're going to cut rates to 2%.
People out there that think if they go 50, they know something we don't know.
I don't know. This is an interesting discussion because I've heard lots of people come out on both sides of the answer. Because what advantage does the Federal Reserve have to market participants right now? Very little. That's pretty much what everybody in the market says. And even Eddie Ardeni, who sees a carry trade unwinding if the Fed were to cut disproportionately, sees that as a buying opportunity. How many investors sort of start to see that carnage as a buying opportunity?
They're in the business of managing financial conditions. That's what they're in the business of doing. And they know their words carry a lot of weight. They have to be very careful about what they say. And I think you got a clinic of that with Janet Yellen over the weekend, with a big dose of politics, of course.
Do you think that she does see more weakness and she's just saying?
What I think doesn't matter. Once you get into the business of trying to work out what people actually think, I just think that language is consistent with what you hear at the Federal Reserve.
I would agree with that.
Consistent with what you hear across every single Fed official right now at the FOMC, regardless of whether they think we should go 50 or 25.
I would agree. There is a very sort of whitewashed kind of rhetoric that you're hearing coming out of the Federal Reserve.
Big time, the real meat on Wall Street. Let's get to Morgan Stanley cutting its oil price forecast for the second time in a number of weeks amid mounting global demand challenges. The bank now seeing Brent averaging $75 a barrel for the fourth quarter, $71.60 on Brent, $68.25 on WTI. Last week, a difficult one.
OPEC Plus is going to have to do more than just decide to not put more barrels into the market. They're probably going to have to start thinking about cutting, especially in 2 months' time, as you hear traders come out and say we are oversupplied in 2025 and 2026. This just feels like kicking the can down the road. And how much do they want to maintain a floor in these prices, especially when they're up against the behemoth of the United States?
Sort of chasing those forecasts lower over the last few weeks. Lots going on this week, including this: Apple gearing up for its most important event of the year, where it will unveil its next generation iPhone, as well as major updates to its Apple Watch and AirPods. The Glow Time event kicking off at the company's Cupertino, California headquarters at 1 p.m. Eastern Time. Joining us now to break this one down is Bloomberg's Mandeep Singh. Mandeep, good morning to you, sir.
Morning.
How excited are you? How excited should we be about this event?
Actually, this is one of the biggest events in the last 2-3 years, simply because when you look at generative AI as a theme and how Apple is perceived as being missed out, I think this is where it all comes together for them, or it doesn't. And look, they don't have their own large language models, but what they have unveiled is Apple Intelligence. And you want to see how is it going to drive the refresh rates. I mean, at the end of the day, whether it's AirPods, watches, smartphones, you want to see them do things with their own apps. So their email app, calendar app, there is so much room to deploy AI on top of their own apps. Forget about the third-party apps, and that's what you want to see at the event.
Is it a big event just for Apple or for the whole AI ecosystem, the whole trade?
I would say the latter, the whole ecosystem, simply because we know the market is undersupplied when it comes to NVIDIA GPUs. AI inferencing is how the large language models get used. Right now, everything is being done on NVIDIA GPUs. If Apple unveils a phone that can do AI inferencing on the phone, that's a big deal. Suddenly, your inferencing costs go down. In fact, I would argue the NVIDIA undersupply situation also gets resolved to an extent because you can run AI on your phone, and it's free, by the way. You don't have to pay up as much for your co-pilots or your chatbots because you're doing it on the phone. So it's a very big deal for Apple if they can showcase that.
I'm glad you say it's free, because this does not come cheap for Apple. And we've seen how much NVIDIA has been able to increase their margins by how much they're charging, and how much OpenAI is being valued at based on all of the potential investment. Can Apple afford to keep the prices pretty much level?
Absolutely. I mean, look at it this way. You're paying upfront for the phone. So if it's a Pro Max phone, you're paying, $1,000 or $1,200. But then you can use it for 5 years. You can use it the way you want. It's all free, as opposed to using a Copilot subscription or a ChatGPT subscription.
I guess that my point is that a lot of people are looking for Apple to increase pricing for that iPhone just simply because their margins are getting compressed. And they're turning into more of a utility than this high-margin, huge cash flow behemoth that it was celebrated for. So at what point does it have to succumb to the margin pressure by increasing prices at a time that there's a real question about consumer demand and ability to pay?
I mean, Apple has got different tiers, and that's what they have done over the years. There's a Pro Max, there's a Pro, then there is a 16. So they will offer you different variants. The basic functionality is they've got all these apps, email, calendar, they've got Siri. Just connect Siri with all these apps and show the utility of a voice assistant on the phone. The phone will sell itself with the tiers, and the margins will be taken care of.
Mandeep, Mark Gurman, our colleague, said he wants to offer a dose of reality, no offense to people like you, who thinks this is going to be a super cycle, with the fact that he says that a lot of these AI functions aren't even coming out till next year, and they're not even going to be offered in places like the EU or China.
Well, so Apple obviously has this event, and then it has the iOS 18 release. That's the big one. That's where all the functionality will be deployed. And look, right now, all the Gen AI functionality is being run on the server. That's what I meant when I said NVIDIA GPUs are used for both training and inferencing. If you can do things on your phone, and Apple just has to deploy that on a chip that it owns, so it's not relying on any other third-party vendor for that chip. If it can deploy that in the next 6 months, everyone will be excited about that opportunity for the next 4 or 5 years.
This is software, though, and some analysts are talking about that actually the more excited for the AI 17 because that will be hardware. Is that really going to be almost the holy grail of this new AI phone when you link up the software and the hardware, new look and feel?
Yeah, that's always been Apple's strength, the vertical integration, the fact that they can do everything end to end. And I think, look, they are working on a chip that can run these AI models. Obviously, the AI models will not be of the same size as those are being run on NVIDIA GPUs, but on the phone, it will be a small language model. The question is, what can it do? Can it really enhance Siri from answering just basic queries to actually doing these Gen AI functionality that everyone is using in copilots and chatbots?
That's the detail that I want. When you say, if you can do this on your phone, do what on your phone? What are we talking about doing?
Like, simple thing is prioritize notifications on your phone. So we get a lot of notifications on our phone, whether it's messages, emails. Can the AI in Siri prioritize it? Can I instruct Siri to take something off my calendar and do subsequent, like an AI agent type of functionality? So all these are basic things. Like, think of it as a very intelligent chatbot. Right now, you are interacting with OpenAI's GPT chatbot through the app. That's being deployed on the server. If you can do that on your phone, you don't mind sharing data through the email or the calendar that you have because it's all sitting on your phone.
So like a personal assistant?
Yeah.
That's the direction of travel?
Absolutely.
Okay. Mandeep, thank you, sir. Mandeep Singh of Bloomberg Intelligence. Are you buying one? We all want to know. Bramo?
Well, I just remember when we first got Alexa and the kids, what they tried to do with it was see how far it could go. So they would ask as many questions. Tell me a joke. Tell me, you know, are you married? You know, when do you die? When were you born? You know, all these sort of personal questions. Maybe Siri will be able to have more personality and people can, you know, have real relationships with their phones.
Two things on Siri. When I hear Mandeep speak, all I keep thinking about is sounds like I'm going to miss a doctor appointment if I leave it up to Siri. And also, just a few weeks ago, I was talking to a guest and Siri picked up that I was talking to her. So now I've banned Siri actually from my phone because I just don't use it. I don't really think it's great.
You missed the punchline. Relationships with your phone. Is that what you just said?
Well, can you imagine if somebody's sort of, you know, talking to their phone says, you know, you look great today. No, you really should just keep going with it. You know, they can give advice. It could really, like, you know, support you.
I haven't given this much thought.
You should.
But okay. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Kering shares are dropping in Europe, down nearly 4%, currently trading at its weakest since 2017. Kering has been hit with 2 sell-side downgrades this morning at Barclays and RBC. Barclays noting the luxury weakness in China, saying it looks structural, not just cyclical. RBC struck a similar tone, writing that the luxury sector is incrementally softening, and Gucci will be especially affected as it transitions to new design aesthetic. Anthony Blinken is set to discuss the Middle East and Ukraine on a 2-day trip to London this week. The Secretary of State is the most senior U.S. official to visit the UK since the Labour Party came into power in July. The White House says UK Prime Minister Keir Starmer will be in Washington later this week. And Couche-Tard has reaffirmed its interest in 7 & I. The Japanese owner of 7-Eleven had rejected the initial $39 billion acquisition bid. Couche-Tard said it wants to work with 7 & I to agree on a friendly buyout. A deal would be the biggest ever foreign takeover of a Japanese company. And that's your brief. John.
French for night out. French for night out. Couche-Tard.
Couche-Tard? In English, it doesn't translate.
Okay. Doesn't go with the logo? You know, it's Canadian. Doesn't make sense. The French-speaking Mrs. Ferro taught me that over the weekend, so there you go. Up next on the programme, sending the right signal.
Typically, when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
That conversation up next. Live from New York City this morning. Good morning.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures on the S&P 500 with a little bounce relative to the big loss we saw last week, up by 0.7% on the S&P 500. Under Savannah's this morning, sending the right signal.
Typically, when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration. I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
So here's the latest. Traders turning their attention to CPI on Wednesday for clues on the Fed's path ahead. Friday's weaker than expected payrolls report failing to settle the debate over how aggressively the central bank will cut interest rates. Sonal Desai of Franklin Templeton saying the data do not support over 100 basis points of cuts in the next 3 meetings. I still see rates dropping to only 3.75 to 4%, absent a recession, which is not my base case. Nonetheless, it is a close call, and a dovish Fed could prefer to validate market expectations. Sonal joins us around the table. Sonal, good morning to you.
Good morning.
3.75 to 4. Where do those numbers come from? Let's start there.
Okay, so that basically comes from a view of where the neutral rate is. You know, it's been my personal bugbear for the longest time.
You think it's higher than they do?
Yeah, I do. If I look at historically where the neutral rate has been, and if we're talking about the real Fed funds rate, it should be around 2%. That comes from a combination of 2% real and 2% inflation. You get to around 4%. And by the way, it was around that level for a good 50 years before the global financial crisis. So we're talking about a certain amount of recency bias. Nothing drives us to 0 or 1.
The obvious question would be what changed? What changed now versus, say, 2019?
So I think the obvious thing that has changed is a true return to normalcy. In the post-GFC period, I think we just went through a very extended period where people were attributing the low rates to everything from secular stagnation upwards. Inflation was suppressed. Well, inflation has reverted more or less to normal. I'm not talking about runaway inflation here. I'm talking about, you know, inflation, no risks really of deflation anywhere on the horizon. And definitely balanced risks looking forward into the next multiple years in terms of inflation or deflation. I mean, let's not get into the whole fiscal issue because we can go down a rabbit hole there. But it's definitely stuff which is going to keep pressure on inflation. Economy is not collapsing. Look at how we've grown with rates being where they are.
All right, so let's put aside the deficit because we all there.
I thought you'd want to go down the rabbit hole.
We would want to, yeah, but it might take too much time, and there are a lot of other things that we need to talk about. Just put that aside. We are the deficit in this conversation, but there is this concern about what you're seeing in the labor market that is more protracted weakening, and we heard from Neela Richardson of ADP that she is seeing a loss of dynamism in the U.S. labor market. How do you understand that with this idea that the Fed is not nearly as restrictive as people think?
Well, there is a loss of dynamism, and I think the critical thing is to think about starting conditions. We started from a historically tight labor market, conditions not seen in over 40 years, largely fueled by everything that went on in the post-COVID period, but it was historically tight. We kind of need to see it get back to a bit more normal conditions, and most estimates of Nauru are not 4.1 or 4.2, they're closer to 5, just saying.
Well, when you talk about the balance of risks, and this is one aspect that I find really interesting, we were speaking with Eddie Ardeni, what is the consequence for markets should the Fed opt to go 50 basis points? He used to think that if the Fed cut disproportionately, that would actually cause an unsustainable boom in equity valuations. He sees equity markets, the initial response being negative, just simply because of the carry trade unwind. What do you think the longer-lasting influence would be? What is the risk underpinning an outsized move?
I think the risk is twofold. One is, right now, everyone assumes that the market is counting on a recession. I actually don't agree. Look at where high-yield spreads are. We're at 325, maybe 350, somewhere. We've been range-bound. Risk assets and fixed income are not pricing in a recession. What they're pricing in is outsized Fed moves, which I think is probably unrealistic. Now, if the Fed actually goes by 50, I can see the market pushing the Fed to continue, right? 50, 50, 50, 50, and it doesn't need to. There's an enormous risk doing it that way, I'd say. I mean, does it result in another rally? Maybe not at this stage. There are many other things going on. We don't know what's going to happen in November. There are lots of uncertainties.
Does it result in higher inflation?
Well, I don't think monetary policy in and of itself is going to trip us into higher inflation at this stage. I don't think so, unless they do something crazy. But I do think the combination of monetary policy and whatever happens in the first 3 to 6 months of next year via fiscal policy, that could.
Do you think, given the fiscal policy of next year, potentially we don't know whether or not the Fed is going to be on a rate cutting cycle or hiking?
They're not going to be hiking. Look, they're not going to be hiking. We are at a decent level. That's a very outside scenario. I do definitely think that the market pricing of rate cuts all the way down to something like 280 by the end of next year is wildly overblown unless we seriously believe they're at risk of recession. And I repeat, at least fixed income markets are not pricing in a recession right now. They're not.
When you say you don't think the Fed is going to have to hike next year, the Peterson Institute thinks potentially they would because of things like Trump tariffs and immigration policy.
Those are imponderables, right? So I would say that there's that. You get another $1.7 trillion helicopter drop coming in the first 3 months of next year. Absolutely, they might be left in a situation where towards the end of next year they might have to hike. It's just not my base case. My base case is that we're in a holding pattern. I think the market's overreacting right now. And I think the end point is closer to 375.4. I'm talking about the entire cycle, not end year.
So given what you believe and given where we're priced, what are you doing? We've got a 2-year down to 370, 10s at 374. You mentioned high yield spreads in the 320s. What are you doing? What are you buying?
Neutral. We're pretty neutral. We're a little bit, we're edging into duration here and there. We're looking for value where we find it. But honestly, spreads are incredibly tight if we really believe there was a recession, which is why we don't believe that's what markets are actually playing right now.
Interesting. Sonal, always one of the best. A clinic, as always, on fixed income. Thank you. Sonal Desai there of Franklin Templeton on a big rally we've seen in fixed income recently.
I'm still thinking about our discussion earlier and this idea of 50 basis points. The rate, we've said a lot. The rate cut that could be disproportionate to how it be perceived by markets. And whether it would be a good thing or a bad thing, whether it would convey pessimism, whether it would have a sort of, negative feel, especially if they came out and they said they were really worried about the market, they'd really worried about the labor market. I still think that markets would cheer. I still think so. I still think right now, people want the big cuts. They don't think that the Fed has an edge.
Sonal's point's interesting, though. Are we sufficiently restrictive or not? Torsten Slok really weighed into this debate on Friday. The lags, you could argue, are much longer because of the post-pandemic fiscal stimulus. We saw the massive fiscal transfers to consumers, to households. We saw how many companies termed out their debt. We saw a lot of that last week as well. Are they just super long, or are we sitting here and saying rates weren't high enough?
I think when people look under the hood, each industry was affected completely differently, and it's very difficult to bring it together with one overarching narrative.
I heard Mike Wilson of Morgan Stanley in the pandemic talked about these rolling recessions and these rolling recoveries, and that's what it's felt like. Coming up, Jim Bianco of Bianco Research will catch up with David Vogt of UBS, Neil Dutta of Renmac, and Victor Yort of BNP Paribas. The third hour of Bloomberg Surveillance up next.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch. plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because there are risks to Ukraine's independence. If there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
They need to gather in the room and think hard about, do we want to go towards 25 or 50?
I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral.
You cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Animal spirits are alive and well, and the Fed has to be careful about that.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We are 90 minutes away from the opening bell. The cash open this Monday morning, just around the corner. The third hour of Bloomberg Surveillance starts right now, with equity futures on the S&P 500 rallying 0.7%, reversing some of the losses from last week. A 4-day slide on the S&P 500. On the Nasdaq 100 up by 0.8% on a Russell of small caps, with a very, very small bounce. The week ahead looks a little something like this, dominating the concerns of economists around the world. CPI and PPI, Wednesday and Thursday. The main two data points, and Lisa, we should throw in jobless claims as well into the mix ahead of next week, September 18th. The Federal Reserve decision just around the corner.
And how much has the focus really shifted to the labor market and away from inflation as the preeminent factor heading into that September 18th decision? For now, it seems like everyone very much is putting an emphasis on jobs, whether or not they really are deteriorating as quickly as some people suggest, and whether inflation really is dead. And this is something we were just talking about with Sanal Desai. What would it take to create and sort of reignite some of those inflation fears that we had just a couple months ago?
Chairman Powell sounds like a single mandate central banker right now. Do you think the rest of the committee still sound like a dual mandate central bank?
It seems like an increasing number of them are saying the balance of risks is shifting and they're focusing more on the labor market. To Mohamed El-Erian's point, though, about the single mandate, right now this market is trading as though the Federal Reserve is a single mandate. If we get an upside surprise, and this to me is going to be the key test, if we get an upside surprise in CPI, does the market care?
No Fed officials speaking this week. We're in the quiet period, 2 Wednesdays away from that Federal Reserve decision. Going into the blackout period, this is the line from Governor Waller. The labor market is continuing to soften, but not deteriorate, acknowledging that policy needs to adjust, but not exactly saying we need to go 50 basis points. That's the takeaway for many going into the weekend.
I love what Steve Risciuto just published, talking about the rate cut arms race, how economists are all coming out and who's going to outpace the other when it comes to deciding what to do. But considering inflation, he says the Fed's desire to provide monetary stimulus to an economy that is fundamentally healthy and benefiting from accommodative markets, as well as what he says excessive liquidity, will lead to stronger growth and more entrenched inflation. So maybe tomorrow's CPI actually is important.
I love how we completely failed to settle this debate. BMO's Ian Lincoln is calling now the decision on September 18th, the photo finish, Andrew Hollenhorst of Citi hasn't changed his mind at all. We are increasingly convinced the Fed will deliver multiple large-size rate cuts as the job market continues to cool.
At this point, the Fed is leaving it open, and Chris Waller did a fantastic job in absolutely settling nothing in his speech, actually keeping the door open to potentially a 50 basis point rate cut on September 18th, which is my birthday. I just want to let you know that to celebrate my birthday, I'm going to be having Fed Day. But to me, I'm just looking forward and trying to understand what data could potentially tip the balance. Is it University of Michigan sentiment survey? Because that once was really important. Is it jobless claims? These are some of the aspects that...
Do you like your birthday?
What?
Do you like your birthday?
I like Fed Day.
Okay.
I like
Sounds like you like Fed Day more than your
I
birthday.
mentioned that it's your birthday, so we're going to have to celebrate it now. We'll do that on Wednesday, next Wednesday.
People might confuse it, though, with, celebrating a rate cut, and then that could get
No, I think they'll be pretty clear that that's not what it's about.
Okay.
We'll make it very clear.
We'll wear hats.
Yeah, if you want us to wear hats, we'll wear party hats. We can do that.
Thank you.
Equity futures on the S&P, positive by 0.6%. I can see that. TK, bow tie, party hats. Bond yields higher by 4 basis points. The 10-year, 374.94. Speaking of the bond market, the yield curve, 2 years versus 10-year. If you're just tuning in, we've said this a few times already this morning. We are positive by almost 5 basis points now, 2s versus 10s, and had the first close in positive territory of the year so far. In fact, going all the way back to the summer of 22.
And a lot of people say, historically, when you see a renormalization of the yield curve, a sort of disinversion, it's typically a bad sign after a long period of inversion, just simply because it means the Fed is cutting, steep is different. So now Desai just talking about how no one is seeing recession, at least when you look at credit market pricing. That's ultimately the question.
Credit spreads are super tight. You'd have to agree with that. Just objectively, just an observation, credit spreads are super tight. That's not screaming recession. Brent crude, just to finish things up, WTI and Brent crude a little bit positive this morning. We're at 68 on WTI and Brent crude, just short of 72 after a big week of losses last week, almost 8% on WTI crude. Big move lower across those 5 days last week. Coming up on this program, we'll catch up with Jim Bianco of Bianco Research, with stocks looking to snap a 4-day losing streak. David Vogt of UBS ahead of Apple's new product launch, and Victor Yort of BNP Paribas on why he's bearish on credit markets. Speaking of, we begin with our top story. Stocks looking to snap a 4-day losing streak following Friday's payrolls report. Jim Bianco of Bianco Research is not buying the gloom. I'm a no-lander. I still do not see a broad slowdown in the economy. The labour market is showing signs of cooling, but these may be measurement problems. Jim joins us now for more. So, Jim, let's go to the bond market first. Why is everyone bullish bonds, given what you just said?
Because the Fed's going to cut rates and they're going to lower financing costs, and we're having a debate between 25 and 50 basis points. And I might add, too, when you said everyone's bullish bonds, if you look at most of the surveys, whether you're talking about the BofA Global Fund Manager Survey or the Commitment of Traders Report, we've got some record bullishness across the board in the bond market. So everybody's positioned for a continued fall in interest rates. And usually when they get that extreme, you're very close to the end of the move.
So, Jim, you said there's measurement problems. Can you walk me through what you meant by that?
Remember that when we do the survey, when we do payrolls and we look at employment in the United States, we do surveys, and those surveys are adjusted by population growth. The population growth in the United States has exploded higher in the last 3 years or so because of migration. We've gone from about a 0.2% population growth in 2020 to 1.1% population growth, and that's a gigantic move for that. And so all these surveys are being adjusted by population growth, and you have to ask the question as to whether or not we're actually measuring it correctly. If we had stable population, the answer would probably be yes, but under this flux of population that we've seen, there's a lot of questions. And I think it really comes down to more on the household survey, where the unemployment rate is measured, less so on the payroll survey.
You're speaking in tandem with Patriot over at Apollo, Torsten Slok, who put out research over the weekend pointing to just response rates declining, that the current population survey has gone from about a 90% response rate in 2012 to about a 70% response rate today. I'm just wondering, Jim, what gives you confidence that the lack of clarity that we're getting speaks to bullishness and not bearishness in the labor market?
Because when you look beyond the labor market, and let's take a look at consumption or retail sales has beaten the Wall Street estimate 25 of the last 31 months. And the consumption numbers are very strong, especially where they were pre-pandemic. And so what that says is that there's a lot of spending going on in this economy. Well, what's the big driver of spending is income. That must mean that there's a lot of jobs out there. People have a lot of income. Yes, the savings rate has been falling, and that can explain some of it, but not all of it. And I think what it does do is it masks the payroll report and the household survey are masking the jobs that are created that you actually are seeing in like the retail sales and the consumption numbers because of how high and strong they are.
That said, we are seeing some real weakness. When you talk to executives of retail companies or beyond, they all talk about how they are seeing more choicefulness, if you like that word. I think it's a little confusing, but people are being more discerning in how much money they spend. Where do you place that in this trajectory of no landingness that you see?
Well, the economy, when it grows, if you look historically at all of the cycles, to use a statistical term, it has a wide standard deviation. So it might grow at 2.5%, but you'll have quarters in there where it might grow less than 1 and quarters that it grows more than 3. And I think what we're seeing with that discrimination among consumers, and especially don't forget that it's an election season too, and that has a big effect on them, that we're seeing probably more of that normal noise that you would see around an economy that is growing near or at potential. Yeah, we had some quarters late last year when we were growing at 3 or 4%. We had a very weak first quarter this year. We're looking at low 2s probably for the third quarter on GDP growth. So that's kind of in the normal range of things you would see with the economy. But add it all up, average it out, and it does look like an economy that is not at risk of recession at this point.
What's the biggest catalyst, though, that could have you maybe back off this no landing scenario?
Probably if the inflation rate were to continue to move lower. Now, I'm going to, for argument's sake here, I'm going to use a year-over-year CPI. In June of 23, it was 3%, and everybody said we're on the last mile. Well, now it's 2.9. It's taken 14 months to go from 3% to 2.9, and it did make a move towards 3.7% in the middle. There hasn't been much progress in terms of inflation moving lower. If you look at like Cleveland Fed median CPI, or you look at the Dallas Trim mean PCE numbers, these I think are better core measures of inflation than ex-food and energy. Those numbers have kind of stalled out too at very high levels. If the economy is really slowing, we should see the inflation numbers continue to move lower, and we haven't. We've seen them settle out at a late rate well above where the Fed wants, and we just assume that they're going to move lower. So if they do start to move lower, then I would start to say, then there is some broad-based weakness.
So you have concern that potentially, or do you have concern that a rate cut would mean somewhat, potentially, reacceleration of inflation?
Yeah, that's my biggest concern. I'm in the camp that the new inflation rate is somewhere between 3 and 4%. And I might add, that's exactly what it's been for, as I mentioned before, the last 14 months or so, between 3 and 4%. And whether or not we get a Harris or a Trump administration after the election, it looks like we're going to have spending, we might have tariffs, and we're going to see a big fiscal response out of the federal government. You add into that easy monetary policy, and yeah, I could see where we could be of inflation, not to 9% or anything like that, but solidly staying above that 3% level and being very worrisome for a Fed that's got a target of 2% and said that they will get to that target of 2%.
So, Jim, this raises some big questions about the projections that we get next week in the SEP, the Summary of Economic Projections. And I can share with you where CPI is right now in those projections, called PCE, 2.8% for 24, 2.3 for 25, 2% for 26. Can you share with us where you think that will be come next Wednesday and how high they'll be revised up by the time we get to 2025?
Well, I don't think next Wednesday that those numbers, for at least for 25 and 26, are going to get revised much. But the story with the Fed's SEP is always the 2-year out number is always at 2%. And then as that 2-year number becomes 1 year and 6 months, they start to revise it higher. And I think that that's going to be probably more of the same when it comes to where the Fed is. And let's remember in June, the Fed did acknowledge that there is a base effect in the inflation numbers, meaning that the seasonal data, the seasonal factors are turning positive, meaning they're going to push the numbers up through the second half of the year, which is why back in June, they upped their forecast to 2.6% for 2024. So I don't suspect we're going to see a lot of movement in the 24 number. Probably the 26 number will stay at 2% or right on their target. So, that's going to be the key, though, is whether or not the inflation rate does move down.
Jim, this was great. Jim Bianco, of Bianco Research. Jim, thank you, buddy. Going into the Federal Reserve decision next week. Speaking of forecasts and taking a completely different view compared to, say, Jim Bianco, Andrew Holmhorst of Citi, I mentioned him earlier. This note just dropped. This is what he's got to say. The message from the September jobs report was clear. The unemployment rate is higher than the Fed forecast and likely to revise higher. Fed officials will need to revise up their unemployment rate projections and are likely to cut rates at least as fast as markets expect. Our base case, wait for this, in our base case, delivering 125 basis points of cuts over the remaining 3 FOMC meetings this year. I assume that's a 50-50 and a 25.
I do wonder if they are going to increase their unemployment rate, just considering where they are and that the unemployment rate is above where they say that we're going to end the year. To what degree do they speak to that weakness, and how does the market respond to it? Just Jim Bianco said something really interesting. I just want to sit on that.
He said a few things.
He said a few things. The idea that lower inflation, so if we get a surprise to the downside on Wednesday, would actually challenge his view that we're in a no-landing economy and would make him think that actually maybe the economy is weakening much more significantly than he thinks.
Interesting. As Jim speaks, futures roll over. Equity futures still positive, though, by about 0.5%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. China's CPI came in overnight at the weakest level since 2021. The calls grow yet again for more effort to boost household spending. According to one measure, its economy is in the midst of the longest streak of falling since extended losses after the data, ending the session on the verge of a 5-year low. Morgan Stanley has cut its Brent forecast for the second time in just weeks. It had expected $80 a barrel in the fourth quarter, but now Martin Ratz and team see an average of $75. That's still higher than the current price of just under $72. Trafigura, for its part, has an even more bearish outlook. Speaking at a conference, the firm's head of oil said it could go as low as $60 relatively soon. And men's tennis, #1 ranked Jannik Sinner took down American Taylor Fritz at a star-studded U.S. Open final on Sunday. The rising star from Italy took the match in straight sets. The 23-year-old shook off the controversy surrounding a banned substance he was found to have taken unknowingly earlier this year. The win marks his second Grand Slam title of the year. He had won the Australian Open back in January. That's your brief, John.
Danny, thank you for that. I think it's fair to say that the men's tennis recession in this country is coming to a close. Fair to say?
I should hope so. What do you
Shelton,
think?
Fritz, Tiafoe.
What caused the recession?
What caused the recession overall? Over like the last 20 years?
Yeah.
Okay, this is a long, long story. I haven't got enough time. I've only got about 30 seconds.
So do it in 30 seconds. Come on.
I think that the birth of these professionals like Rafa, Federer, and Djokovic completely changed the game. Before them, you were a specialist on any given service. So we had these American hardcore players, and then you had players like Gustavo Kuerten, who would only turn up for the French. Goran Ivanisevic, who would only turn up for Wimbledon and would do nothing on the other surfaces. Just something changed with those three players, where they just were able to dominate across multiple services, across all the slams.
I just want to know why. Nutrition? Something in
change of grass at Wimbledon, you know. Change the game at Wimbledon as well.
Genetic modification.
Yeah, all of that. We can get into that in a moment.
Let's do
this. This is not a 30-second response. It's much longer than that.
Carry on.
Up next on the programme, the Morning Calls Plus. David Vogt of UBS, ahead of Apple's new product launch. That's next. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, the opening bell at 1 hour and 11 minutes away. Equity futures are bouncing and positive, up by 0.6%, following a 4-day slide on the S&P to close out Friday. Time now for the morning calls. First up, Morgan Stanley raising its price target on shares of Costco to $9.50 from $8.55 and keeping an overweight rating. The firm calling Costco a best-in-class retailer. That stock up by 0.2. Next up, B of A upgrading JetBlue to neutral from underperform and doubling its price target to $6 a share. The analyst saying recent trends in travel and fuel prices are a tailwind. And finally, Wedbush maintaining an outperform rating on Apple with a price target of $285. Analyst Dan Ives saying today's launch of the AI-driven iPhone 16 model lineup will kick off the biggest upgrade cycle in Apple's history. Heard that a few times, haven't we?
I'm shocked. He's bullish?
Is this one going to be different? David Vogt covers Apple for UBS and has a neutral rating on the stock with a price target of $236. David joins us now for more. David, welcome to the program. Let's pick up on what Dan Ives had to say. What are you expecting from this launch? And could it really trigger, ignite that upgrading cycle that so many of the bulls have been looking for now for a number of years?
Great. Thanks, guys, for having me. So I'd say first, from a product expectations perspective, we don't expect anything material today that hasn't been reasonably well telegraphed in the market. So you'll get some iPhone 16s, you'll get a new AirPods generation, you'll get some new watches. But net, we think the product introductions have been well telegraphed. In terms of the cycle, we are considerably more cautious about what the next 12 to 18 months look like. And there's a couple of different reasons. One, we think obviously the application suite is going to be somewhat limited and isn't really going to drive consumer growth. Second, there's some geographic limitations in terms of the launch. So remember, this product is not going to be launched in China, nor will it be launched in Europe. So those are the second and third largest markets in the smartphone market. So net, we don't subscribe to the supercycle market expectation that I think the market is sort of underwriting at this point.
What would you have to see, David, to change your opinion?
So I think a couple of things. One, applications matter, right? So you need the software community, you need the ecosystem to really build applications that are going to get people excited to buy new devices. Remember, these devices are summary emails, gen emojis, some writing tools, nothing that's really going to change your day-to-day productivity. So to spend, upwards of $1,000 US or euro to buy a new device is a really tough sell when, quite frankly, there are a lot of other devices on the marketplace that have applications very similar. So we need to see a much more robust ecosystem over the next 12 to 24 months. And the challenge that Apple faces is this is the first product that they've launched in history that I can recall that's beta version and doesn't have all of the features at launch. So they're going to be waterfalled in over the next 12 months or so. So it really doesn't give the consumer really anything to grab hold of.
That's the reason why pricing is going to be so interesting at a time where margins are getting compressed by how much Apple's trying to invest and buy into the AI craze. How much do you want to see them increase prices at a time where consumers are being more discretionary and, frankly, where there is competition that also does harbor AI?
I think we're in the minority here. I don't think they can raise prices. So if you go back 2 years ago, when we had rampant inflation in the U.S. and Europe, you had the beginning stages of the Ukraine crisis. Apple actually raised prices in Europe and in the U.K. by basically 100 euros and 100 quid. Ultimately, unit sales fell pretty dramatically, anywhere from 15 to 20% on a year-over-year basis in that market. So there is some elasticity. And I think Apple learned its lesson. So last year when they announced new products, they effectively didn't raise prices other than dropping the low end of a storage configuration. So net, despite the more robust processor, the more robust camera specs, et cetera, we don't think they're going to be able to raise price because ultimately consumers, to your point, are price sensitive right now. And I think ultimately that would impact demand.
David, given the fact that you're basically outlining that these AI functions, the Apple Intelligence is kind of being unraveled here, half-baked, What are you getting when you buy this iPhone that you don't have on your iPhone today?
So the first thing that I think people talk about is you're going to have an integration with ChatGPT/OpenAI. That said, in our view, you already have the application, so it already works reasonably well on your device. So I don't think that's a game changer. But what Apple's been talking about is, functions like email summarization, writing tools, these Gen emojis, which, quite frankly, we'll see how that plays out. So I think, look, when you talk to the company, these are early days. Obviously, this is the initial platform. But again, you need the developer community to really build applications and functionality to get people involved. If you go back to the iPhone 12, I'll use that as a great example. Everybody thought the 5G marketplace was going to drive huge sales. Well, we're sitting here today, and I live in Connecticut and work in New York. The ability to roll 5G out pretty pervasively has been pretty limited. So I think you need the ecosystem to really drive the applications, which will then drive handset sales. We don't think that's over the next 12 to 18 months.
And why are we not going to be able to get these functions in the European Union and in China?
So one, China, the regulator, has not signed off on it. There's a suite of considerations like privacy and the ability for the local regulators to have access. So at launch, we think, or soon after launch, we think Apple might work with a local provider like a Baidu, but that effectively would be a Me Too product. Every OEM in China will have that functionality, so it doesn't set Apple apart. And we think, look, Europe is a tough market for Apple, right? You have the EU looking at them from a DMA perspective. There's a host of regulation. And so there's obviously friction between, we think, Apple and the EU. And so net, it's not going to be a widely distributed product. The other point, which I didn't make earlier, is this device is only going to be running European or American English. So that also limits the applications in terms of countries where this is going to be rolled out. So again, it's going to be a much smaller launch than we think people anticipate. We'll talk about what the iPhone 17 could look like maybe a year from now, but near term, we think this is going to be something.
Come back soon. After we see the launch, we'd love to catch up with you, get your thoughts and talk about what was happening next, particularly what's happening in China as well, where things are really, really soft. David Vold there of UBS. Things are not good for Apple based on that assessment.
Yeah, especially because you don't have sort of the exit ramp of China or of Europe, especially given the fact, and his point here I think is really important about the beta, and that it's very rare to roll out something that's a beta launch and then have to have people play catch up with software updates later on, and yet here we are.
Rare is a kind way of putting it. It's not good, is it?
How do you lure people in? Does Jonathan Farrow need to upgrade to something that doesn't upgrade until early next year?
With great difficulty.
Unless it folds.
Unless it folds. 4 times, as you said earlier.
Yeah. Then I buy.
4 folds and I'm in.
Totally.
Game changer. Neil Dutter up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Live from New York City, welcome to the program as we kick off a brand new trading week. Equity futures on the S&P 500 positive by 0.5%, coming off the back of 4 consecutive days of losses on the S&P 500 and the worst week of the year so far. On the Nasdaq, up by 0.6%. Your opening bell 1 hour away. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, very good morning. Yeah, this time last week we were talking about record highs across the index. Some names that are really on the move. Boeing is bid this morning. It was a little bit higher. This is potentially removing some of the headwinds for Boeing, doing a deal on the docket for 33,000 mechanics and factory workers. What do you get? 25% pay rise staggered out over 4 years, a commitment from management to build new airplanes in the Pacific Northwest. If this deal goes through, it helps remove some of those issues for the new management. Dell's also up there, joining the big club again. This along with Palantir. Dell back in the S&P 500. Citi actually say, look, you can still get a little bit more momentum in this stock on the upside. Why? Because you're going to see an infrastructure spend and the PC demand, that refresh cycle coming through. So they're going to get a double uplift according to Citi as they go back into the big club. Tech is really a focus. NVIDIA is something that psychologically, I think, drives the narrative every day. We're up just 1 1/8%, but I want to put it in context. Down 14% last week, and what you've got here is Citi saying that this stock, and this is prescient, this stock is becoming just another growth stock, and its deceleration in the rate of forward guidance is going to have less of a profound impact on the overall trajectory of the S&P 500. That is quite the call from Citi. But here we are, Jonathan. The debate is whether there's a little bit of a move in dollar-yen or just clawing to get onto some more solid ground this morning as we kick off the trading for the week on CPI.
Manus Cranny, thank you, sir. Appreciate it. That 14% move on NVIDIA, Lisa, that is $400 billion over that period.
So I put out on X this idea that it was sort of these record swings that we saw in market cap, and I got so much hate mail, which I want to do. But the hate mail was basically, well, of course it is. It's inflation, asset price inflation. It's such a big stock. But that highlights just how significant these moves have been in market cap and how we sort of shrug them off as just sort of typical in the modern world.
That's a J&J, just sort of like gone.
Wiped off.
Just like that. It's ridiculous. The numbers are ridiculous. They're absolutely ridiculous. Manus, thanks for that. Let's talk about the week ahead. Traders gearing up for a busy week of economic data, starting with CPI on Wednesday. On Thursday, we'll get PPI plus another round of jobless claims and an ECB rate decision just around the corner as well. And on Friday, the University of Michigan Consumer Sentiment Survey. Mike McKee is with us to break it down. Good morning, Mike.
Good morning. I don't think we're going to get a whole lot of interest this week in terms of the numbers because we are pretty good, not we, but the economists on Wall Street are pretty good at forecasting inflation numbers. And right now, they're not seeing much change at all from last month. We're looking at a 0.2 gain for both headline and core on CPI, a 1/10 gain in PPI final demand, and that doesn't change much. The headline year over year comes down a little bit, but basically what it leaves you with is the Fed in the same position as they are starting the week. They can do whatever they feel is necessary, and nothing's going to compel them one way or another. We'll have jobless claims. The forecast right now is for 229 after 227. Basically, I think economists have given up. It's just like whatever last week was, we'll add one or two until we get some kind of a change.
You come on, you're basically like, go to sleep until next Monday and come back on next Wednesday, and then we get some answers. To me, I think it actually is going to be a threshold is. How low the bar is for the Fed to have an outsized rate cut, what they're looking for in terms of weakness, where things are going to matter. Is it going to be the University of Michigan sentiment survey and what 500 people say about what they feel the inflation will be over the next 5 to 10 years that could skew the difference? I mean, doesn't that make it interesting?
To a certain extent, it makes it interesting, and the composition of the inflation reports will be interesting. Take out energy, but the rest of it, we'll see the breadth of inflation and if it has really collapsed, as Jay Powell says, and that would be good news. The thing is that the Fed has sort of taken inflation out of the equation by saying we're there, basically, and it's going to keep happening, and we're going to get down to 2%. So it would take a big surprise to affect what they're going to do, for inflation to affect what they're going to do. Now, we hoped that jobs would give us some sort of clue as to what they were going to do, but it came out right in the middle, so nobody really knows, which makes that really interesting, because how long has it been since we've had a meeting where we did not know what the Fed was going to do in terms of monetary policy? I mean, how many times have I sat here and you guys sit here and we all say it's what they say, not what they do? But this is going to be about what they do and what they say.
Well, you were on with us Friday when William started to give his remarks, but what was your take on Waller? Because he started speaking later, and people have read that a few different ways.
Yeah, I think he kind of left an opening there because he said we could do more if necessary, depending on the data. Well, there isn't a whole lot of data between now and the Fed meeting that's going to affect that decision. So my read was that he was saying after this September meeting, if we get data that says go 50, we'll go 50. And I think that's what he's referring to. And so we'll have to, that will make November very interesting. And we'll be talking a lot about what they say in the summary of economic projections, what their forecasts are. The dot plot will be very interesting for Wall Street. We'll have a lot to talk about going forward because they will have started the cycle, and it's then what are they going to do?
Mike McKee, thank you, sir. And Mike's absolutely right. For the first time in a long time, we've got a live meeting on September 18th at the Federal Reserve. Let's cross over to Neil Dutta of Renmark. Neil joins us now. Neil wrote this piece over the weekend on LinkedIn. You can access it yourself. Go and search for Neil Dutta. We've pulled you a quote. Neil, I want to share the quote with our audience and get your response to it. I'm seeing a lot of wildly optimistic takes out there. Almost feels like people are allowing a political narrative to cloud their analysis of the data. The fact is conditions are getting worse, not better. There will be a time to be bullish. I'm not sure now is the time. The Fed should go 50 when they can, not when they must. Now, Neil, the obvious thing to jump off the page there's a couple, but the political one's interesting. What is your view on that? Are you suggesting that there's some economists out there, maybe even Fed officials, that have got a political narrative? What's that line about?
Well, not Fed officials really, but, certain economists on the street are sounding like that. I mean, the same folks that told us, we're at a sustainably higher run rate for employment with 200,000 because of immigration, and now all of a sudden telling us that, well, don't worry about it, 100,000 is fine because that's what full employment looks like. I mean, it's a bit ridiculous, don't you think?
Well, hold on a second, Neil, because this is actually something that I've given quite a bit of thought to. Are you accusing the current status quo opinion on Wall Street that recession is not imminent as a political construct designed to help the incumbent Democratic Party?
No, I don't think, I don't think that that's the accusation. I think that there are certain quarters of people that, I don't know, maybe they're jockeying for jobs in the administration. Who knows? I mean, but I do think that look, no one needs to talk to me about being optimistic. I'm one of the most optimistic people historically that's been on the street. Yourself, but wonder, these wildly optimistic takes seem a little bit out of place. I mean, this notion that, this is a soft landing, this is boring, things are good, hooray, we're at full employment. I mean, at the end of the day, up is up and down is down. Okay, I mean, it's really that simple.
Okay, but what is sort of the base case, Neil, that you're talking about here in terms of where people are getting it wrong? How bad do you think it actually is? And why do you then think that the Fed should go 25 basis points rather than 50 basis points, even though everyone on the street doesn't seem to think it's that bad?
Well, I think things are getting worse. I mean, at the end of the day, since Powell talked about we don't seek or welcome further cooling in the labor market, literally every single labor market indicator that's come out has been worse than expected. ADP, the non-farm payroll number, job vacancies, the regional manufacturing employment indicators, the ISM employment indicators. I mean, the labor differential from the Conference Board. Literally, you can go on and on and on. And, you know, we're told to say, oh, well, don't worry, layoffs are low. As if that's a leading indicator of the labor market to begin with, which it's not, by the way. I mean, the hiring rate has collapsed. You know, I mentioned immigration before. Look at college unemployment rates. The unemployment rate for people with a bachelor's degree. That's 0.5 percentage point higher than it was the same month in 2019, right? So how does immigration explain that? So I think it's a little bit, you know, off-putting, frankly. And to the extent that, you know, I think, for me, I think the important story is that I think the economy is evolving in a way that the Fed may not be anticipating. And to the extent that that's true, I think it creates the risk of an accident later, which is something we've been arguing, obviously, since June. And the only reason to expect 50, and yes, I still believe that a 50 basis point rate cut is possible at the September meeting, that's our call to our clients, is because of Jerome Powell. We can talk about Waller, New York Fed President Williams. All Jerome Powell needs to do is get out there and before his colleagues around that table and say, I think we should go 50, and they'll all fall into place. And in fact, a lot of the people on the street that have 25 basis point rate cut calls, they'd have no problem with the Fed going 50 either.
But Neil, how political could it be for the Fed to go 50 if Jerome Powell is the one almost dictating it, not a consensus building from the ground up?
I mean, I think that a consensus would come around to the chairman. I mean, Anne-Marie, if they didn't go 50 and they only go 25, and that potentially fuels bets that the Fed will be behind the curve later, and then we're talking about even larger moves after the election, how would that not be political? I mean, to me, they have full clearance to go 50 as it is. And I do find this sort of argument, well, if they go 50 to start, it would be a panic. That would be a panic move. Well, by that logic, maybe they shouldn't go at all. Show much confidence to the market that why not just not do anything then?
Neil, we know you think they should go 50. What do you actually think they will do?
I told you, I think they will go 50 because I think Jerome Powell is going to give them license to go 50. I think he thinks that they should go 50.
So, Neil, let's build on that. The kind of communication you're expecting September 18th, together with the signal we could get from the projections in the SCP as well. Did they characterize that as a mid-cycle adjustment, a rush to get to neutral? How do you think they'll frame that move?
I think that they'll go 50 and they'll say that they're willing to do more so long to stabilize the labor market. That's how they'll frame it. They'll say that the inflation story is over, inflation has been quelled, and we'd like to stabilize labor market conditions at our estimates of full employment.
Will you feel better if there's dissent on the FOMC?
Yeah, I mean, I do think that the consensus building nature of the Fed historically creates an institute all over the world that have more dissents. And, you know, I mean, who are we really I mean, if you're Jerome Powell, I mean, to me, it's like, okay, someone's dissenting. So what? I mean, who cares? I mean, some of these people that will dissent have been absolutely wrong about the overall tone of the data for the last 6 months. I mean, if Mickey Bauman dissents, is that really a big deal? I mean, to me, it's like, I mean, it's like being, you know, kicked by a lesser than. So I think it's sort of not really worth trying to build consensus in that regard, especially when they've been wrong about the overall slope of the data. I mean, some of these people also have been completely head faked by Q1 inflation, right? I mean, so
true.
Look, so what's the point of building consensus with people that have been absolutely wrong about the overall slope of the data for the last, 3, 6, 9 months?
Now you've said it, whoever dissents, we're going to say they're auditioning. Neil, thank you, sir. Neil Dutter of Renmac, appreciate it. Just a clinic, as always, from Neil. Victor Hjort of BNP Paribas joins us around the table. Victor, just to build on that, Neil was worried about the economy, the labour market specifically, thinks they should go 50. You're bearish on the credit market. Did a lot of that resonate with you?
I think for sure the theme that we're moving away from rates risk being a big part of fixed income and credit markets towards ratings risk, meaning fundamentals and downgrade risk and that sort of stuff. That, I think, is absolutely a theme. Maybe I'm a little bit less worried about the labor market than he is, and probably for the simple reason that I don't really see why companies need to shed labor. Corporate profit margins are very high, haven't rolled over, and typically it's the rollover that precedes shedding of workers. That hasn't happened yet, so I'm not entirely sure why I should be too worried about layoffs. But for sure, the credit market right now is very focused on the idea of high rates and still a bit of inflation, and probably have a lot more room to be surprised by more sluggish growth.
Put some numbers on that for us. So high yield spreads in the 320s at the moment. What do you think is fair? What kind of spread widening are you anticipating?
So between now and, say, over the next couple of months, I think, 50 basis points wider. I think you can easily test the wides of early August. But I don't think it's necessarily because the growth is slowing. I think it is because we have that political event in early November, and that, I think, requires a bit of risk premium.
So just extrapolate that out. What does that risk look like? Is this worry about tariffs? Is this worry about just worry itself? I mean, how does this sort of percolate out into wider credit spreads at a time where companies have refinanced? And if you believe it, the economy hasn't fallen into recession.
Yeah, I think it's really about uncertainty. So, when you look during past election cycles, you very often have sort of risk-off periods during September, October into the election, and then big rallies coming out of that election. And they look different from one election to another, and the drivers are different. But one thing that you very, very clearly see most of the time is that there is position squaring going into the election. The net longs go down from mid-September through October and into the election. And that's an interesting story, right? Because what it basically tells you is that uncertainty is a factor here. If you are going into a very binary event, risk managers, to traders, to portfolio managers, tap them on the shoulder and say, hey, why expose our portfolios to some scenario that we're not 100% sure that we can quantify? Why don't we just reduce risk and then put it back on after the election? And I think that story resonates with 2024 as well. You got two candidates that are different. Why should I guess whether, net income's going to go up 7% or down 7%, depending on what corporate tax rates I guess? I probably should just reduce risk and see what happens. And I think that's exactly what will happen. And that means less liquidity and a weaker market sentiment over the next couple of months.
You deal with a lot of clients from around the world, and I'm wondering how true that is, particularly for international buyers of credit, which have traditionally been some of the biggest buyers, particularly of investment grade, and I'm thinking of the Japanese and others.
We have a very interesting story, which I think relates back to some of the stuff that happened in early August with Japan. Obviously, if you have a BOJ that is hawkishly hiking rates and a Fed which is dovishly cutting rates, at some point the economics for Japanese investors to buy into US dollar investment grade debt, it deteriorates. And so that's clearly an angle. I'm not sure it's the main angle here, but we saw sort of a test run of that risk scenario in early August, and I think it can happen again.
Ed Yardeni was on earlier, and he was talking about new highs for the S&P 500 after the election because of gridlock, not because of a sweep of either party. Is gridlock also good for the credit market?
I think so. In fact, I think it's probably the best outcome, right? So credit, even less so than equities, is sort of really hugs the lack of volatility type of environment. That's really, high certainty, low movements. That's sort of the ideal environment for the credit market. So gridlock is fine, but I don't think that markets necessarily anticipate gridlock ahead of the event. So, maybe a sweep is fairly unlikely, but if we add up the probabilities of a blue and a red sweep, we end up somewhere around 45% or so, right? So that means that there is a at least if you share BNP's thinking, a pretty high chance that there's going to be some extreme outcome. And I think it sort of furthers this idea that people will choose not to second guess it and simply reduce risk ahead. And that, I think, points towards volatility in credit markets.
Sal, and ask questions later. Victor, thank you, sir. Victor, you're there of BNP Paribas, bearish on this credit market. For the equity market, positive by 0.6%. The opening bell just around the corner. Let's get you an update on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Brown University trustee Joseph Edelman has resigned in protest against the school's upcoming vote on divestment from companies linked to Israel. Edelman had been a trustee since 2019 and is the CEO of Perceptive Advisors. In an adapted version of his resignation letter published in the Journal, he said holding the vote was morally reprehensible and rewards violence and anti-Semitism at Brown. Brian Niccol begins his tenure as Starbucks CEO today. He joins after spending 4 years at Chipotle. Starbucks shares had soared 18% after it named him CEO back in August after 2 consecutive quarters of sales slumps. Niccol and his team will be charged with reversing slowing sales both domestically and in China, long waits and labor relations as union efforts grow. And the NFL season is officially underway. And already the Super Bowl in February has its headliner. Kendrick Lamar was announced as the performer for the halftime show in New Orleans. Lamar previously performed at the event back in 2022 in a lineup that featured Dr. Dre, Snoop Dogg, and Eminem. It's been a landmark year for the rapper. His highly public feud with Drake dominated headlines and led to further critical and commercial success. And that's your brief, John.
Danny, thank you. We'll see you tomorrow morning. Thanks for this morning. Up next on the program, Apple's product launch. Later on today, we'll catch up with Bloomberg's Ed Ludlow, live from Apple HQ in Cupertino, California.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Minutes away from the opening bell. Equity futures on the S&P 500 positive here by 0.6%. Coming up this week, your agenda looks like this. Later on today, Apple unveiling its latest lineup of phones, watches, and more. Tomorrow, Vice President Kamala Harris and former President Donald Trump facing off in their first debate, and maybe only one. Wednesday, the Fed's next big data point, its US CPI. On Thursday, we'll get PPI. Another round of jobless claims and an ECB rate decision. And on Friday, unmatched consumer sentiment. Joining us now from Apple Park, our good friend, Bloomberg's Ed Ludlow. Ed, this is an odd one, and we'd love some color from you. This feels like unveiling something that doesn't exist yet and might not exist for a number of months, maybe even quarters. Can you walk us through how odd this product unveiling actually is?
Yeah, that's an accurate framing. I mean, the most bullish on the street see a super cycle, right, where they believe tangibly the consumer is ready for artificial intelligence on device. But the plan is as follows. We'll probably get 4 variants of the iPhone. Believe tangibly the consumer is ready for artificial intelligence on device. But the plan is as follows. We'll probably get 4 variants of the iPhone 16 generation unveiled today, and they'll start shipping at the end of this month. But as is now well documented, the supporting software through iOS 18.1, in other words, the update that gives you access to Apple's artificial intelligence tool, is staggered, delayed into October. And so there's actually a really interesting element of sort of misunderstanding. For example, the bulls on the street who see the super cycle are very excited about handset upgrades in China, driven by enthusiasm for AI. But as you discussed with your guest earlier, Apple is not making Apple Intelligence available in China in the first instance, pending regulatory approval.
And it is sort of this curious thing. How do you unveil software? It doesn't have the same sort of sexiness as something that folds or something that's got new corners or whatever usually the hardware that they unleash is. How are they going to make a software update that you can't get until next year sexy?
Yeah, I think the story for everyone around the world is, if I'm an everyday consumer, how do I actually use this technology? You know, the beta version of iOS 18.1 has given us a clue. It's text summarization. Some of the reporting from Bloomberg is that it's the image or image generation functionality that's delayed. A lot of that plays itself out on social media, right? It's pretty easy now to create a meme. I had dinner with a let's call them a tech CEO last night, and what I found so interesting is, again, Apple Intelligence isn't going to be released in the first instance in Europe out of concern for some of the regulatory pressure there. But actually in Europe, the consumer isn't as interested as they are. It's easy for me to sit here in Silicon Valley. Literally, I have every generative AI tool under the sun installed on my phone, but that's culturally in line with what goes on here. There's a simple story that needs to be told in markets around the world. This is how you use AI on your device daily, and this is how it will impact either your work or your personal life.
Ed, looking forward to your work and looking forward to catching up tomorrow morning. Look out for Ed a little bit later, a special from Apple Park on the unveiling from Apple of the iPhone 16. Bloomberg's Ed Ludlow. Ed put it perfectly. Very, very simple terms. They need to demonstrate what this actually is now. Without just saying AI on repeat, what can you actually do with this that you couldn't do before?
How do they make it appealing, this idea of just how this can transform your life? If they can show an easy way to make this your personal assistant, that could potentially be transformative, because some of us might need organization.
But the rollout is going to be staggered. It feels like a litmus test almost for these AI functionality. And Ed had a great point. He's sitting in Silicon Valley. Everyone's excited about this. They can't even break into China or the European Union. So basically, they're only going after really American consumers.
Reminds me of Tesla. It's like buy the hardware and I promise you the software update's coming.
Yeah.
It's around the corner.
It'll drive itself. It'll also serve you drinks.
Yeah, all of that.
Yeah.
There's a lot of similarities. Don't know about the drink serving while you're driving. I don't think anyone wants that.
You're not driving.
True.
So, anyway, carry on.
How's that going to work?
I don't know.
Yeah, it's an interesting point, isn't it? Got us thinking now, Bram.
Well, good, I'm glad.
From New York City, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
All right, a little bit of a bounce back today. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, inflation ahead. Futures are pointing to a partial recovery as investors brace for that CPI report due Wednesday.
Apple's most important event of the year kicks off at 1 p.m. Eastern today. We're live in Cupertino, Western, as the company unveils its new AI-enhanced iPhone 16 lineup.
And Big Lots files for bankruptcy after suffering from declining sales for years. Details ahead on that distressed retailer. All that and more. Let's take a look at where markets are trading about 30 minutes until the bells ring. Coming off of the worst week since March 2023 for the S&P 500. You can see, as Matt mentioned, a little bit of a bounce here. Of course, a rally building in the pre-market. The S&P 500 currently up about 0.7%. A slight lead for the NASDAQ 100, currently up about 0.8% on your big tech benchmark. Also having a wipeout last week. And then you take a look at the bond market. A little bit of a rise when it comes to the 10-year Treasury yield, currently up about 3 basis points, Matt.
So last week, we were watching for a disinversion of the yield curve. We actually saw it amidst the worst week for the S&P since 2023, the worst week for the NASDAQ 100 since 2022. That's because usually a disinversion of the yield curve means a recession. Take a look at these disinversions. The red shaded areas are recessions, the disinversions in blue. We had one last week. If we stick to that, does that mean this growth scare turns into a real problem for the economy?
We'll get back into the macro, but first, some pre-market movers. Palantir, Dell, both moving bigly. Following their addition to the S&P 500, they've replaced American Airlines and Etsy, and Palantir is up more than 8.7% pre-market. Dell up almost 5%, and Apple flat ahead of that event. Remember, that product launch is this afternoon. We'll talk more about it this hour, Matt.
All right, getting back to some extent to the macro, we did hear Fed Governor Waller talk about the possibility of front-loading at the end of last week, and really maybe the last Fed comments that we're going to hear until September 18th.
Yeah, we're officially in the blackout period. Let me read you this exact quote, guys. I think it was really interesting. Speaking after that jobs report on Friday, this is Fed Governor Chris Waller saying, quote, "I was a big advocate of front-loading rate hikes when inflation accelerated in 2022, and I will be an advocate of front-loading rate cuts if that is appropriate." This is a fun game, of course. We were having this debate in our morning meeting. What is the most important part of that sentence? Is it front-loading or is it if appropriate?
I actually think it's not that sentence at all. I think it's something he said outside of that sentence, which is that he doesn't believe the economy is in a recession or headed toward one. But he was really, to your point, what set off the bond market after that jobs report. It wasn't the jobs report itself.
I mean, why would he even say that if he doesn't believe the economy's in a recession or headed towards one? He doesn't think it's appropriate. So why would he bother to bring it up?
Also, if the Fed isn't going 50 in September or meeting after, why would he bring up the concept of front loading? We should ask this question to our guests. Sitting to my left, I'm pleased to say, we have Liz McCormick. She is Bloomberg's chief correspondent for global macro markets. So Liz, weigh in. What should we be focusing on when it comes to the speech? Is it the recession probabilities? Is it front loading rate cuts, or is it if appropriate?
Well, I love Matt, but I will say what Chairman Powell has said, even before Waller talked clear, is they're trying to avoid a recession, right? So I don't think Waller needed to say, oh, we're in recessionary conditions. They're trying to prevent that, right?
Well, he doesn't even think we're headed towards that.
Right, well, okay, but they really want a soft landing, so you don't want to get too close, right? So I think, but I don't think he really set up a for sure 50 in September. If you read, like, you know, if appropriate, or will be, he gave himself enough hedges, but I think he's making clear, because they don't like to surprise the market, right? So right now the market's only priced at like 16% chance of a 50. So they're in the blackout. So if, say, CPI or things go that they feel like they need to go 50, I think you're going to see trickling into the press. You know, I won't say leaks, but, you know, their messaging. We saw that on the way up when we had a hot CPI and they were in a blackout.
And they leaked to the Wall Street Journal.
Yes, I wasn't going to say that, but they did leak to the press that it would be a big move, right? So I think right now, you know, I saw Krishna Guha had a great note at Evercore saying, you know, like it's kind of a cheap insurance to go 50, even though his forecast is they're going to go 25. So there's these comments out there of what I think they'll do and what I wish they would do.
Well, let's talk about positioning, because if you look at how far the 2-year moved on Friday, on the heels of those comments, they moved more than 9 basis points, almost 12 basis points actually now, has corrected a little bit. But to the point that you guys have been making also, only a 16% chance of that 50% rate cut in the September meeting, right? Where are we now?
Yeah, September 18th.
Right, September 18th. And through the end of the year, there's still well over 100 basis points. At one point, there were almost 120 basis points of cuts cut in. Have people overcorrected?
Well, there's people saying they are. Like, we have a story out that just has many investors saying the market's gone too far. But the thing is, and Waller kind of left that door open, is, say, like you said, Shanali, the market's pricing over 100 basis points for the rest of the year. So we have 3 meetings, right? So if they go 25, that means they could do the other 250, right? And we have over 200 priced over the next whole year. So that's a lot. So I think that we do, you know, to be nicer to Matt, we do have to see the economy weaken a little bit more and show signs of, you know, the labor market cracking more for them to speed it up. So
heading towards a recession?
Maybe heading towards a recession.
That's not what Waller sees right now.
Although my son tells me I've been calling for a recession forever, Mom, and it hasn't happened, so.
Well, before we let you go, I do want to ask, when you're talking to bond investors, you're talking to your sources, what is the dividing line between, you know, what the Fed should do and what they think they actually will do? How important is that distinction right now?
Well, I think right now very important, because there are many saying, I think they should do 50. They should have done 50 a few meetings ago, right? But they don't seem to want to do it. They want to start gradual, and they're going to go 25, even though I don't like it. I think the key is there's some investors seeing the soft landing and saying, hey, you know, like JP Morgan Asset Management is saying maybe 75, 125 only in the whole cycle. So I think it depends on your view on the economy, but I do think there's a big camp saying, this is what I think the Fed should do, even though I think they're going to do this, right? For whatever that's worth, right?
All right, Liz, thanks so much for joining us. Bloomberg's Liz McCormick there talking to us about 50 or 25. Let's get to Jack Janasowicz about this portfolio manager, lead portfolio strategist, and Natixis Investment Manager Solutions, because, Jack, it matters, right? How quickly and how deeply the Fed cuts. What are your expectations?
Well, thanks for having me back, Matt. And I know you guys had given, I think, 3 choices there. Maybe I'll throw the 4th choice in. The fact that the Fed is finally cutting, I think, is probably the thing that matters even most to us here. And if you get a consecutive series of 25 basis point cuts over the next 2 quarters, I think that's just as fine right now. There's plenty of cover for the Fed to go 50. But even if they don't, the idea that they're finally cutting, I think, is the bigger takeaway that we have.
At the end of the day, does that reflect an optimistic view here, that perhaps that the Fed does not need to cut 50 basis points multiple times through the end of the year? The economy is doing just fine.
Yeah, we tend to fall into that camp where I think the economy is doing just fine. And I think this is somewhat of a growth scare, right? I think the market's over extrapolating some of the more recent weaknesses. But the thing that we fall back on is that household paycheck proxy, right? Simply multiply how much are we making each hour, how many hours are we making each week, and how many people are employed. That's growing at close to 5% on an annualized basis. If we look at the period before COVID, so 2010 to 2020, that was growing around 4.5%. So we are growing well above the pre-pandemic level. And to us, that's basically consumer buying power that's still resilient.
And so, Jack, you wrap that into what we're seeing in the markets right now. The S&P 500 down more than 4% last week. The NASDAQ 100, big tech, down by almost 6%. What you're saying is pretty reassuring that if you take a look at the fundamentals of the economy of some of these companies, things aren't so bad. And yet you take a look at the major benchmarks, not necessarily seeing that same calm.
Yeah, and I think, listen, if you take a step back and some of the things that we focus on, let's pull out the Beige Book, for example. You had wordsmithing there, the comments related to the word soft, softness, softer, softening. You had 55 word counts in there. Recession came up 0 times. FactSet did something that was pretty interesting where they're doing the wordsmithing as well. How many times did you hear the word recession in earnings calls? It's at the lowest level that we've seen in quite some time. So, these companies are on the front line of the economy and they're not mentioning recession. So from that perspective, a little bit of profit taking, not surprising. We all know the September seasonals. We're looking at buying on weakness in here into the end of the year.
So you want to buy on? I mean, I noticed that we do a survey of Wall Street strategists. We had 20 participating in our most recent survey, and the average year-end call is 54.69. So we're pretty much there right now on the S&P, right? All we have to do is gain, I think, less than 1% in today's session, and futures indicate that we are headed that direction. You think we can gain much more than that?
Sure. I don't see why we can't simply head to new highs before the end of the year. And again, take a step back. You're basically getting into an easing cycle. The people that are providing liquidity are telling you we're going to be providing liquidity. And I think that's a pretty big catalyst as we head into the end of the year.
I want to take the flip side of the argument here, Jack, because even though you're quite sanguine about the direction of things, what would cause you at this juncture to change your mind, knowing that we are seeing strains in the consumer and knowing that there are plenty of concerns out there on how fast this labor market turns?
And I think that's the key, right? Just paying attention to what we're seeing in the jobs market. I know we're seeing cracks in the lower end of the consumer basket. It's really a bifurcated consumer, if you will. But again, keep in mind that lower spectrum, that lower quintile income bucket, they account for less than 10% of total aggregate consumption here. So the part of the economy that's being driven is really the upper echelons of that income basket. Household net wealth at all-time highs. Corporate balance sheets are at very strong. I just think it's very tough to make a discernible bearish case in here until you see that labor market really rolling over. And right now, we're just not seeing signs of that.
So with that nuance when it comes to the consumer and with the resilience of the overall labor market, how do you position a portfolio around those views? Where are you finding the opportunities when it comes to sectors, when it comes to specific industries, Jack?
Yeah, I think the big one here is simply that you're going to see that rotation, the market breadth story starting to expand. We've already started to see that happen over the last couple of weeks, right? You're seeing growth slowly taking a back seat. We're seeing a little bit more coming from the cyclical side of the equation. And again, I wouldn't be shocked if we continue to see those parts of the economy working. That means something like industrials, financials. Wouldn't be shocked if those continue to move in here. And maybe you get even a little bit of a bounce off of the discretionary side simply because maybe the market's a little bit overshooting to the bearish side on the consumer. And it ends up being maybe a little better than expected. And you get a rebound, especially in housing, as rates start to move lower.
We had a guest last week, Greg Bottle from BNP, saying that rather than buy the dips now, Jack, he wants to buy volatility when you see that drop off. What do you think about using options here? Does it make sense to you?
Yeah, I think there's a little bit of a case to be made for volatility. Obviously, if you look at the seasonal patterns for the VIX, as we head into the election year, vol tends to be elevated September into October. So maybe it makes some sense in here to be buying volatility. But I think once we get into that sort of beginning of October, I wouldn't be shocked if sell vol comes back into play, and that's what you want to do as you head into the end of the year. And vol basically gets back to more normal levels with a sub 20 handle.
You know, Jack, I get the rationale to dip into some of these underloved sectors so far. Maybe positioning was too bearish one way or the other. But what about too bullish on the other side? You look at the pain that the Philadelphia Semiconductor Index felt last week. Do you think it's justified, and do you buy that dip?
You know, we still think tech works in here, but I think you're going to have that leadership baton being passed off to other sectors of the marketplace. So, sure, tech's taking a breather. Semis have been on a massive run. You know, NVIDIA up almost 170, 180% for the year. Now we've corrected back, so it's only up 100%. You know, it makes some sense to take some chips off the table as you start to hit this volatility spike into the election backdrop. But I don't think you can really dismiss tech in here. So, tech maybe is a market performer, and you might start to see outperformance really spreading out as the breadth starts to widen out. So again, I wouldn't be giving up on tech in here, but certainly that leadership is going to shift hands, we think.
All right, Jack, really great to speak with you. Joining us from Natistic Investment Manager Solution. Appreciate your time. And let's take a look under these markets right now and take a look at what's moving ahead of the opening bell. You can see the S&P 500 currently up about 0.7% pre-market. The NASDAQ 100 up 0.8%. Small caps not exactly joining in on that rebound. You can see the Russell 2000 currently up about 0.1%. There's a lot of movement under the surface. Let's get to Emily Griffeo right now, because the S&P, of course, announced which names are in and out at their upcoming rebalance. Who are we keeping an eye on?
So we're watching Palantir and Dell. Those were kind of the two largest and most significant names that were added into the S&P 500. Those changes will go into effect Monday, September 23rd. It's no surprise that we see kind of two companies that are capturing that investor appetite for AI being added to the index. On Dell, that's the hardware side. Obviously, they supply servers that will power artificial intelligence. And then Palantir, known as a surveillance software company and also a play on AI. American Airlines was removed. I guess that's underscoring kind of the industry woes that are plaguing the airline.
Oh,
It's a polite way to put it. I appreciate that.
We've noticed. I'm looking at the biotechs here. We've talked so much about Keytruda from Merck, but apparently Summit Therapeutics has a better drug to beat cancer, and that's obviously made the market happy.
Yeah, that's at least according to analysts on the street and investors this morning. We're seeing that stock up about 38% in pre-market trading, and they showed over the weekend at a presentation that there's statistically significant improvement in progression-free survival compared to Merck's lung cancer drug. You look at what H.C. Wainwright had to say, analyst Mitchell Kapoor, he said the Summit drug is clearly better than Merck's in non-small cell lung cancer.
That's good news.
It sure is, and you see it in the stock as well. There's another thing that's moving this morning. I wanted to talk about Squarespace and Permira amending their deal agreement here.
Yeah, they boosted their buyout bid for the company. The two companies said in a press release that they signed an amended merger agreement. Squarespace shareholders will get $46.50 per share in cash. That's about $2.50 higher than the previous offer price, and brings the transaction to a total of $7.2 billion. And of course, we're talking about the website publishing company Squarespace and Permira, the private equity firm, looking to buy them.
All right, Emily Griffeo, really appreciate that roundup. Now, coming up, we'll get more analysis next on Boeing after the company seemed to score a couple of wins in Seattle and in space. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Getting out of high interest to look at what's making headlines around the world. Couche-Tard told 7 & I that it wants to work together to agree on a friendly takeover of the Japanese convenience store operator. The move comes after 7 & I, which is open to a sale, pushed back on the Canadian company's initial proposal for being too low. Talks are set to intensify over what would be the biggest foreign takeover of a Japanese company ever. Meanwhile, B. Riley is negotiating the sale of a majority stake in its Great American Group and the financing of Brand's portfolio, with the company expecting to raise around $400 million. The company intends to use the majority of those proceeds to accelerate debt repayment. Bloomberg reported last month that Oaktree Capital was in exclusive talks to acquire majority stakes in both entities. Both transactions are subject to the completion of due diligence. And Boeing shares are actually up in the pre-market, trading on rare optimism that a labor deal with its largest union will help avoid a potentially crippling strike, I should say, at its Seattle area factories. The troubled plane maker hammered out a landmark deal over the weekend, which includes a 25% pay hike over 4 years and a commitment to build the company's next plane in Seattle, according to statements from both sides. Janelle?
Matt, we're going to stay on the Boeing story. Joining us for more is Bloomberg Deputy Editor for Global Aviation, Sid Phillip. He is in Washington today. And you think about this deal alone, it includes a wage increase over 4 years, plus an immediate benefit here to the laborers. How much of this is a win for Boeing's CEO, Kelly Ortberg, who has really just started to take the helm here and try to turn things around for the plane maker?
Morning. Yeah, for Boeing, this is a massive deal because essentially it could potentially avoid a crippling strike that could sort of decimate production, and then that would sort of lock up free cash flow. So for Boeing to get cash rolling again, a deal is crucial. It's still early days. We still need to see what the workers decide to do. I mean, there's 33,000 workers, and they will vote on the deal on September 12th. So it's still early days. There has been discontent from the workers, and they have been sort of very anti-management in the past. So it will be important to see how it goes from here. But for Boeing, potentially, if they can get a deal through, it will be a huge win because they can sort of keep production going and actually get jet delivered and basically unlock cash for themselves.
So a win for Boeing, an early win for the new CEO, Kelly Ortberg. I have kind of a curveball. I want to talk about the space program, of course. That's really been taking a lot of the attention over the past few weeks. Astronauts stranded in space. Is Kelly Ortberg going to kill the space program? I mean, it seems like he sort of has a free pass from Wall Street to kind of take a knife to a lot of these things.
Yes, so for Boeing CEO, I mean, there's a lot of issues that he needs to resolve and get his feet on the table and make sure that they can sort of come out of all the various crises. And so it is still early days. We still don't know what his priorities are on space, but given the fact that the commercial aviation business is in such big turmoil at the moment, and they have other issues across the board, it will be interesting to see what sort of position he takes on the space business. That was also a sort of rare good news moment for Boeing because they managed to get the Starliner back to Earth, and we will still have to see what the details are and what they sort of what they learned from the landing, but it did make it back successfully.
Right, empty, of course. We're showing video there of people coming into the ISS, and that is not from the Starliner return because it was completely unmanned. They were afraid it might kill all the people aboard because of helium leaks they've been experiencing. I mean, Boeing has just been losing. We're talking about, a rare bout of optimism on Wall Street today, Sid, but they're off, I think, 40% year to date, and they are down from $250 billion market cap to less than $100 billion now. Is this company, though, too big to fail? I mean, are they so important to the national security of the United States of America that they could pretty much, shoot somebody on Fifth Avenue and still get elected?
Oh my God.
It is very important. I mean, given the fact that there are only two plane makers in the world at the moment, there's Airbus and there's Boeing, and Airbus can't really take on the work that Boeing can't make. So essentially, it is vital that Boeing gets its act together, and it is too big to fail.
All right, Boeing shares down about 40% through Friday's close. Sid, really appreciate you playing along. That is Bloomberg's Sid Phillip, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
All right, let's get a check on futures with about 4 minutes to go until those bells ring. You can see we have a little bit of a rebound rally on our hand. The S&P 500 up about 0.7% pre-market. Big tech up 0.8%. Even the Russell 2000 now getting in on some of the action. Of course, we're coming off the worst week since March 2023 for the S&P 500. But guys, 150 basis point cut from the Fed, and that's in the rearview mirror.
Fascinating. You actually have two-year yields on the rise today. So let's see if these expectations recalibrate, especially going into the big day.
Yeah, the first day of yields rising in 5 sessions. I just note that a lot of people were buying this rally on the way up recently at high valuations. So if we continue to fall, if we get another week like last week, they're going to have to sell.
Going to turn into, I don't know, we'll see.
A meltdown.
A meltdown. This is Bloomberg.
you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's a new week. It's a new session, moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. After the worst week for the NASDAQ 100 since 2022, we're looking at gains on those futures, 0.9%. Here you can see S&P futures up about 0.8%. A little bit of optimism that we're going to finally get a Fed cut, although we still have a CPI read in the way before that. You hear the opening bell down on the New York Stock Exchange as well as the NASDAQ market site on Times Square. We have a lot of superlatives in terms of the horrible week that was, Katie, but it looks like we're going to see a little bit of a revival in risk assets today. What are you seeing in the first moments of trading?
A relief rally, if you will, because you take a look at these markets, of course, as the bells ring, we are 25 seconds into trading, and there's a rally to talk about. You can see the S&P 500 currently up about 0.7%. The NASDAQ 100 up 0.9%, leading here. Of course, as you said, it was a very, very bad week last week, so still quite a hole to climb out of there. And then you can see the small cap index also seeing a little bit of green today. The Russell 2000 up about 0.2%. Meanwhile, let's take a look at some of the single names here, because we have to talk about Palantir and we have to talk about Dell. The announcement coming out on Friday that they're joining the S&P 500 later this month as part of its latest quarterly rebalancing. You can see shares right now rising in anticipation. Sonali.
I'm also watching shares of Summit Therapeutics just soaring more than 32% at the open here after the biopharmaceutical company presented the latest data of its lung cancer drug, which is a direct competitor to Merck's Keytruda. You have Merck down now about 4% at the market open, Matt.
As long as one of them works, we'll be happy. Apple holding its annual product launch today with a focus on the next generation iPhone and refreshed wearables, but also a lens into, at least we hope to get a lens into, they're going to spin it into a lens into Apple's AI future. You can see that investors don't look terribly optimistic. Just minutes into the start of trading, the shares are down 0.3%.
Also, lack of optimism in Big Lots. It has filed for bankruptcy, and the shares are tanking after years of declining sales and closing locations. The discount retailer agreed to sell its business to private equity investor Nexus Capital. We have Bloomberg's distressed debt senior reporter Eliza Ronald-Hannon joining us now, who was reporting on this for a while. And how does the Big Lots story compare to what else you're seeing in the world of retail at a time where people are really worried about the consumer?
Well, it's a bit of an optimistic story, believe it or not, just because you've seen so many retailers who file for bankruptcy these days going in with the knowledge that they will liquidate. So simply using Chapter 11 to apportion their assets and repay creditors. But against all odds, sort of, Big Lots has a buyer, will continue to operate and exist if all goes well, and is planning to shut, not many more of its stores, and really continue to operate as a big chain retailer. And that's despite the fact that it has reported losses for almost every quarter for several years now.
Growing up in the great state of Ohio, I'm very familiar with the chain, and it was bustling back when I was a kid in Newark, Ohio, in the 1990s. But what's the store like now? What do they need to change? What do they need to turn around, Eliza, in order to get back on their feet?
Well, I think they need a macro turnaround a little bit because it has really suffered from consumer trends. So even though you would think that consumers trade down to discount stores like Big Lots in a crunch or amid of inflation, it's been more of this time around at least, this round of inflation, this crunch has affected lower middle class Americans so much, and they are the ones who are the target shopper for a place like Big Lots, and they are simply spending no discretionary income on home goods whatsoever. They're just trying to buy food and gas. So if that loosens up, that'll do the trick potentially for Big Lots, but I think they also really need to focus on basics. They had for a long time shifted their focus to furniture a little bit, and that was not the best move for them, especially once housing slowed down and there wasn't as much appetite there.
And it's important to point out, of course, that shares of Big Lots still halted after an absolute wipeout. Great reporting. Really appreciate your time on this Monday morning. Our thanks to Bloomberg's Eliza Reynolds-Hannon. And for more on these broader markets, let's turn the conversation over to Marianne Bartels. She is Chief Investment Strategist over at Sanctuary Wealth. And Marianne, just one more time, let's run through just how bad last week was. The NASDAQ 100 down nearly 6%, worst week since November 2022. The S&P 500 down more than 4%, worst week since SVB collapsed. Are things really that bad?
No. So the way I'm looking at it is that this is a test of the August lows. And we're starting to get some fear and panic in the market. So how do we measure that? We look at the VIX index, which measures volatility. That's above 20. And historically, when you're above 20, it's been a very good time to actually buy equities. If you look at the put to call ratio for equities, we're starting to see some panic in there. And some of my breadth measures are getting close to buy signals. So we may have a little bit more volatility, a little bit more chop, but I think what the surprise might be is September's not going to be as bad as some people are anticipating.
At the end of the day, what does this mean for how much drawdown you might see, Marianne? Because if you think that things are not so bad out there, yet there's this much choppiness, it really raises the question, what's the floor?
Well, the floor, and that's really it. That's not what I'm really focused on. You may get there, you may not get there on a test. The indicators suggest that if we have 1 or 2 days of really big chop, we're going to really start getting some great buy signals. So I think we're pretty close, which means none of us can really time the markets exactly when they bottom. But now would be, if you were looking to buy the markets, we think this is a good time to actually be nibbling in the markets, because we do believe we're going to continue to get a year-end rally.
What about the concern, our Bloomberg stock story pointed out that a lot of investors have been playing catch-up in this rally, right? And you can see that with strategist targets. They keep having to raise targets as the index climbs higher. If they're buying at, already kind of heady valuations, and we see a correction like the one we saw in August, or a week like we saw last week, don't they have to sell earlier? Doesn't that kind of take, the conviction hodlers out of the equity market?
Not if we get a year-end rally, it doesn't. And let's, we've all been talking about the amount of cash that's on the sidelines that's not participating. And, we are expecting the Fed to cut rates on the 18th of this month. If rates really continue to come down, as that cash matures, it's going to be looking for a new home. So I think that's another potential driver. And another driver is the employee tax credit from COVID. The IRS is starting to actually open that back up again. So I think you're starting to see some more liquidity actually come into the markets. And I think part of the concern also is we're in a presidential election, the uncertainty of who is going to be the winner. And I think once we get past that, the markets will really find their footing and have a really nice rally. And remember, November tends to be a great month. October, we create important bottoms, but we actually might make an important bottom here in September instead, because too many people have been focused on how weak September is.
And I appreciate you outlining, of course, the sources of fuel of that potential year-end rally. And I want to talk about the composition of what that could look like. If you think about who is actually going to lead that, does leadership look like the big tech names, of course, some of the most beaten down stocks right now? Or do we maybe see that broadening out that we had been talking about so much maybe a month and a half ago?
We've definitely have seen a broadening out. We've seen interest rate sensitive sectors like REITs, utilities, even some consumer staples, and you even have healthcare in there, start anticipating a rate cut. That's allowed the breadth of the market to reach a record all-time high. That's where I get some of my conviction that this rally is not over. And we've had confirmation from volume. So those two have been very important indicators. Tech has not come back the way you would think tech would come back or tech related. I'm watching that very, very closely. I don't think tech performs as we go into the end of the year to see how they're actually going to perform for next year.
How do you define tech? Because you think about the weakness you've seen in the Philadelphia Semiconductor Index. I'm pretty obsessed with kind of just how much you saw a sour tone to start the month.
She's not lying.
I've been talking about it a lot. Well, every single stock in that index through the end of last week was down. You are seeing a boost in the index to the tune of 1.8%. Now, what is with the attitude? Do you think that this kind of undertone of sourness sticks around?
So you bring up a really good point. Semiconductors have been the leader of this tape, and they're very, very important to watch. They have been weak, but I haven't seen anything significant in terms of the leadership signal that they're ready for a breakdown. So I do think they can rally into the end of the year. I'm more concerned about 2025 than I am this year. So I'll watch this rally that we get in technology as an indicator on how markets might be behaving, because leadership really drives the direction of markets over time.
All right, we're going to check back in with you soon, Marianne. Great to get your take. Really appreciate it. Marianne Bartels there of Sanctuary Wealth talking to us about what she sees happening in equity markets, and then more specifically what she's watching for example, in tech. I know you're watching it very closely. I think it's fascinating that you had all members falling for so many days, trading days in a row.
I think it's fascinating that you have this divergence. You have some places like Citi making Apple their top AI play over NVIDIA, but others still holding on to NVIDIA as the story for AI. We'll see.
Speaking of Apple, we are live next from Apple Park. Is it really called that? Apple Park in Cupertino, California, ahead of the latest product launches. They're going to want you to think that AI is involved in everything they make from this point forward. Do you buy it, is the question we pose. This is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Top global leaders like Bloomberg Television and Radio.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
All right, this is Bloomberg Open Interest. You're taking a look at stocks 15 minutes into trading. You can see a big, beautiful rally on our hands. The S&P 500 up 0.9%. The NASDAQ 100 up by more than 1%, of course, just covering the scars of last week, but still a rally nonetheless, extending to the Russell 2000 up about 0.4%. Meanwhile, it's time for our top calls. Some of the analyst action in focus this morning. And first up, JP Morgan says U.S. Steel is a buy. The firm is upgrading the company to overweight as it sees a more favorable risk-reward for steel stocks. JP Morgan also raising Nucor and Steel Dynamics. Next up, Deutsche Bank says Colgate-Palmolive is no longer a buy, downgrading the consumer products company to a hold. The firm says it's approaching the final months of this year, quote, with a degree of caution as companies contend with slower sales growth. And finally, Citi says that it's time to buy MarineMax. It upgraded the boat retailer and raised its price target, calling the stock a strong play on anticipated Fed rate cuts. Citi says that boat affordability has been hit hard by the high rate environment, Matt.
Yeah, tough to get a boat these days at a low rate. I know that. Today, Apple will unveil its latest lineup of products. Bloomberg Technology's Ed Ludlow is in what is apparently called Apple Park in Cupertino, California for the event. Ed, I'm sure that they want us to think they have installed a massive amount of artificial intelligence into all of these products. Is that the case?
I mean, that's the simple question, how much of it's accessible straight away, but also just the simple story. If you're a consumer with a prior generation iPhone, what is it that prompts you to upgrade? You know, the expectation is you get 4 variants of a new iPhone 16 generation with sort of modest hardware upgrades. And if I think back to WWDC earlier in the summer, the story was very much that, look, it's the kind of hardware optimization that's going to make AI on my smartphone something I'm interested in. But as Bloomberg's Mark Gurman's reported, you know, the new iPhones will Apple Intelligence, its artificial intelligence platform, will come in iOS 18.1 next month. And there's kind of this staggered rollout. Although I would say the street seems pretty bullish about the idea of a super cycle with consumers around the world just really ready, Matt. They're so ready to use AI on their phones.
Ed, are they ready? Because the other thing Gurman points out, I love how he phrased this, is allow me to provide a dose of reality. That's everything from weaknesses in China to consumers around the world holding on to their money, and everything down to the technology itself, that it can't deliver in that near-term horizon that those bulls want. Is he right?
Yeah, there's a lot of skepticism about sort of what's actually useful. If you look at the beta version of iOS 18.1, you know, in the age of generative AI, it's quite basic stuff, right? Text summarization is an example. Some of what will come in later releases of iOS, you know, is somewhat delayed according to Bloomberg's reporting, is the image generation tools. And as far as I can tell, like using a generative AI text-to-image tool is largely used for meme creation based on social media. I don't sort of see that much beyond the creative arts happening. So that's kind of an interesting standpoint.
Election interference.
It really is the question of timing, right?
I mean, Ed, are you suggesting that meme creation isn't a worthy goal here for AI? The hopes and dreams?
Katie Greifeld, for you, meme generation is your raison d'etre. I get that. But you have to think about the smartphone market in aggregate, right? I think the forecast is that actually we'll have a good year in full year of 24 if you go on IDC data or whatever, but that's largely driven by Android. Next year, the delay, but there will be a comeback for iOS and the iPhone, driven by some of this sort of staggered release of AI tools.
I was half joking, but I really do appreciate you taking that seriously. It's very Ed Ludlow of you. Let's talk about some of the other products that we're going to learn about today. Of course, watches, AirPods. What else should we be keeping an eye out for?
Yeah, so 4 variants of iPhone 16 generation. But if you think about it like this, wearables and iPhone in aggregate is 60% of revenue. And while you have this annual cadence of smartphone handset refresh, it's been a couple of years since on the wearables side, there has been a rethink and variety of new products. And there's a lot of excitement around that, particularly at the low end when it comes to AirPods, because that might bring in new buyers that are yet to be a part of that ecosystem. And of course, as we always talk about on Bloomberg, right, the services story depends on the installed base. How many of the devices are you using and how much of that prompts you to part with your cash on a monthly basis, subscription basis for other software tools. So that will be a big part of it as well.
Ed, we thank you so much for your time. Looking forward to your reporting throughout the day and maybe even some scoopage. We'll see. That's Ed Ludlow in Cupertino. Now, coming up, we're going to break down Murdoch's grip on News Corp with a Starboard filing a proposal to do away with that dual-class share structure. That's next in our Wall Street Beat. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Let's take a look at the stock market as investors pile in to buy that dip. The S&P 500 up about 0.9%, a strong start to the trading week. The NASDAQ 100 even more so. Big tech up 1.2% after that beating that index took last week. And the small caps, of course, getting in on the action to a lesser degree. The Russell 2000 currently up about 0.3%, Sonali.
And it's time now for the Wall Street Beat. Today, we're focusing on a new call by Starboard Value to end News Corp's dual-class share structure. We're going to get more details now from Bloomberg's Crystal C. I want to read some of this letter. It is punchy. It says that the 4 Murdoch siblings with voting rights within the trust are reported to have widely differing worldviews, which collectively could be paralyzing to the strategic direction of the company. This is according to Starboard. We are not sure why their perspective should carry greater weight than the views of other shareholders. Now, Starboard is a shareholder. I love it. I love a good drama on a Monday morning. Crystal, how much clout does Starboard have in this fight?
So Starboard has been very effective in asking for changes in the boardroom, and like you said here exactly, it's very dramatic. It's almost like a succession in real life, where you have Stewie, which in this case is Jeff Smith, playing the role of trying to like change up the boardroom dynamic. But right now, what he's filing is a non-binding proposal with the AGM. It doesn't mean that it's going to automatically show up in the ballot. So shareholders are not immediately voting for the abandonment of the dual-class share just yet. But he's making the point that because there are so many children of the Murdoch family, they may not come to the same conclusion, and you no longer have the argument of keeping that visionary leader who is Rupert Murdoch, because he left the company last year in the chairman role.
Stewie, I cannot get that image out of my mind now.
Stewie, I actually didn't watch the show.
Succession?
It's a good time to now.
It seemed like a little bit depressing. I started it, and they were like, had servants trying to play softball for $1 million.
The dialogue is top-notch.
In any case, how realistic is this, what they want, with such a small stake?
So right now they're filing for a small stake, and they have both Class A and Class B shares. Just taking the stake aside, the amount of the stake aside, the dual-class structure has been increasingly unpopular in the market anyway. So if you go to a proxy advisor, someone like an ISS and Glass Lewis, they haven't been the biggest fan of this structure. And even the exchanges have had rules where if a new company were to have that structure, they need to have a sunset clause to it. So I think this may resonate with a lot of passive shareholders, as well as the proxy solicitor corporate finance community here. So in a corporate governance sense, this argument makes sense. But whether the Murdoch family can keep News Corp within its family trust, that is something that they would definitely fight very hard for.
We have about a minute left here. It's really interesting to see this particular industry go through this type of transformation at this point in time. Does that have anything to do with it, the landscape itself?
So there's a lot going on in media. You know, we've seen a lot going on in the activism world. Disney had a couple of very big activist investors. I think media as a whole, with streaming coming to people trying to monetize streaming, it is really in a moment where it has to come to some sort of either consolidation or some sort of reckoning. So that would really present a lot of opportunity for activist investors. So we may see more of that coming up, and this is really playing out in real time now.
Yeah, I think that's the most interesting sort of 35,000-foot point, right? Everything is in a bit of chaos right now, and it needs to be put back together.
And the vultures are circling.
Exactly. All right, Crystal, thank you so much for joining us. Crystal C, they are talking to us about this activist campaign and media. Let's get to the trading diary. This is what you need to be watching this week. Today at 1 p.m. Eastern, Apple holds a product launch, so if you're shopping for something, I guess this is what you can look to for any progress. Kamala Harris and Donald Trump have their first television debate in Philadelphia on Tuesday. That's kind of the big deal until the inflation number comes out on Wednesday, CPI before the Fed's next meeting, and Friday we get the latest University of Michigan Consumer Sentiment Survey. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Brokers Studio in New York City and to our worldwide audience. Alex Steele, Paul Sweeney, we're live here. We're also streaming on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. It's Apple Day. Big event here. iPhone 16 going to be launched here. Going to be a big news for the company in terms of refresh potential. Anurag Rana, Bloomberg Intelligence. He's going to break it down for us, what it means to the company. Thomas Netzel is going to join us, Bloomberg Intelligence. He covers the European banks, apparently HSBC making some changes there. Maybe the structure of the company merging their commercial and investment bank. They're looking to cut market call. What does he expect this Fed to do? Then Michael Halen, he covers the restaurants for Bloomberg Intelligence. He's saying the restaurants are ramping up promotion, marketing. It's getting competitive out there to reach these consumers. We'll talk to him about that. All right, coming up, let's kick this off with Lisa Mateo and a Bloomberg Business Flash. Lisa.
You got it. And Markets Driver is brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, stocks recovering after a sell-off due to cooling U.S. jobs data really left traders wondering how aggressively will the Fed cut interest rates next week. Now, this week we have more data on tap. We have a focus on the cost of living, the Consumer Price Index Wednesday. We'll also get a report on producer prices Thursday, import prices on Friday. Now, right now, coming in, we have a read on wholesale inventory. So right now, the survey was for up 0.3%. The actual came in at 0.2%. The prior was for 0.3%. Let's get the reaction on Wall Street, shall we? The NASDAQ up about more than 1% at 204.16,894. The Dow up 0.7%. 294 points, 40,645, and the S&P 500 up 0.9%, 52 points, 5,461. We have the 2-year yield at 3.68%. That's up 3 basis points. The yield on the 10-year 3.73%, and that's up 2 basis points. We have the dollar showing its strength. The Japanese yen weaker, euro, British pound weaker. We have Bitcoin up 2% at 55,000. And glow time for Apple. Yeah, that's the name of the event today. Shares are up. Wanted to check in, up about 0.3% ahead of it. And speaking of AI, the cloud computing has gotten pretty good boost from it. Today, we're going to see how that pans out for Oracle. It reports quarterly results after the close. Right now, Oracle shares up about 0.1%. And Boeing up 3%. The company reached an agreement with its largest union, increasing wages 25% over 4 years. Also a commitment to build its next plane in the Seattle area. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. Does glow time remind you of like a Bob Fosse song? Like I'm picturing like people in all black with white gloves and like, a clown face and like a little bit of a jazz hands thing.
It'll be a show, I'm guessing.
That's what I'm saying.
Yep.
All right, well, just for, an important message for our listeners in San Francisco, starting October 1st, the place to listen to us in the Bay Area is on the Bloomberg Business app. It works seamlessly in your car with Apple CarPlay and Android Auto. Make the switch today because October 1st, Bloomberg Radio is streaming directly to your phone. The Bay Area's new home for Bloomberg Radio is the Bloomberg Business app. Download it free at the App Store and on Google CarPlay. All right, let's get more on these markets here. Vince Signorelli, a Bloomberg macro strategist, joins us. I'm surprised because if I take a look, Vince, at some of the top movers right now within the S&P, United Health is one of them. Was there a catalyst here?
Yeah, I think what we saw Friday with the jobs numbers, there was a big drop in healthcare employment. And I think that's why we're seeing the drop in Humana, United Healthcare, CVS, and the like. There's a little bit of anxiety that the surge in hiring for healthcare is done and maybe overdone, and maybe that earnings for those shares might be turning lower in the near future.
All right, it's Apple Day, Vince. I'm upgrading. I don't know about you, but
Want to because you have to.
Kind of have to.
It's not like, ooh,
thing.
Cool feature.
No, it's the Steve Jobs, Tim Cook Apple issue where it just kind of the battery issue. The battery goes. What's it mean for the stock? Do you think, Vince?
Right now we're not seeing much of anything. The stock is down about 0.5%. I'm not an Apple. I own an Apple iPhone, but it's a 12. So I'm not upgrading. I'm not chasing. I'm not addicted to this. I don't use probably 1/10 of the features that are in this phone. So I don't know what AI is going to do for me. I don't know what a button for a camera shutter is going to do for me. My iPod, my AirPods are fine. I gave up on my iPad. So I guess it's going to do a lot for a lot of people. Whenever these things come out, it's always a big hooray. But I still just don't get it. I don't get where all of the resources in the balance sheet of a company like Apple are going necessarily when you're putting AI into a handheld versus doing something a little bit more dramatic.
Well, it's interesting, though. Like, you listed all the products that you have and that are okay, that you like, and that's kind of the point. Aside for the iPad, they have this ecosystem from you, and because of that, they have a giant subscription revenue and services revenue from you, even if you don't really know that you're paying it. And, like, therein lies the bull case at the end of the day, Vince.
Yeah, but I think one of the things that I worry about with Apple is, obviously a lot of their revenue is coming from the App Store, and we're bordering on sort of a monopoly issue. And I just wonder, at any day now, will we see the likes of, folks like Elizabeth Warren and maybe a new president coming down on them and suggesting that that is exactly what that is and forcing them to spread that revenue around, which obviously wouldn't be good for the stock. Just seems to me all their eggs are in one basket, and that doesn't make me feel comfortable. But it obviously makes a lot of people feel comfortable.
It's a pretty good basket.
And, and their products are obviously addictive.
Yep, they are, and count me as one of them. One of my offspring is not in the Apple, so he's been kind of ostracized by He's just not.
Well,
I have one of those too, where I
Did you read that great big take that said that, if you wind up communicating with iPhone to iPhone, it's a blue bubble, but if not, it's a green bubble, and like that actually comes with stigma sometimes if you're in a group chat.
Well, this is my offspring. He thinks he's smarter than all of us, so he says the Android is better. He's got it better. So we're like, okay, all right.
We believe you, but bye-bye.
Yeah, smart guy. All right, Vince, thanks so much for joining us there. Vince Signorelli does all the market stuff for Bloomberg. Let's switch gears a little bit and talk about some of these international banks, because there's some news coming out here. Let's go first to Anurag, because he's my personal iPhone shopper. So Anurag, his day job is he's kind of the senior technology analyst for Bloomberg Intelligence. All right, so Anurag, you and I were talking earlier today. I need to get the iPhone 16 Pro. Is that what I'm getting today?
Yeah, so the Pro series has two sizes, the small one or the big one, whichever one, you like and you can handle it. I think that's what you should be getting.
All right, all right.
Is it a buy the rumor, sell the news today?
I think that's been the case for Apple. And again, I think Mark Gurman's done some really good work on this thing, especially when it relates to the AI features of it. Because when they gave that presentation in June about what they are, coming up with, it was really impressive. But now we are hearing that these features will be staggered throughout the year. It's not going to be available in EU. It's not going to be there in China. So, and brand new form factor. Now the 16 is going to look like the 15 or the 14, so there's not a whole lot of difference in the way it looks. So if you stagger that with a launch that's going to take some time, then you will look at some refresh rate, because the unit shipments haven't grown in the last 3 years. So we are expecting, let's say, a 5% bump in unit shipments, but the bigger push on the iPhone will most likely come next year with the launch of iPhone 17.
I can't wait that long. I'm going to go.
11. So it's going to feel like
11.
Huge difference for you.
Huge difference for me. All right, Anurag, can you update us on the China issue, i.e. the revenue risk for Apple in China? Where are we in that?
Yeah, so it's a very big market. In fact, it is the biggest market for iPhones for Apple. And right now, there is a competitive landscape there is very tough. Consumer spending is tough. So, for us, AI aside, the big thing for Apple would be how it does in China next year. And then there is a factor of elections, because if Trump comes to power and he starts putting a big tariffs on China, and we get into another or a bigger fight with China, that's not a good thing for Apple, because they, as I said, 20% of revenue comes from that region, but they make most of the phones and the parts in that area. So the most exposed Magnificent Seven, in our view, is Apple when it comes to China. And anytime there's a big problem between the two countries, everybody's looking at what would happen to Apple.
Yeah, and that's an interesting point, too, when you talk about an iPhone super cycle. Like, how can you have that if you don't have China also getting in on that? So I have literally heard about the super cycle since 2016. I remember sitting on Studio One, having this exact conversation with people, and it still has yet to materialize in the way that everyone talks about, and getting pushed back to 2025. Should we stop talking about a super cycle at this point?
I think any cycle is good for Apple right now, because last 3 years unit shipments have been flat. So as I said, small benefit this year, but frankly speaking, the biggest reason people change phone is the reason why Paul is changing his phone is because the battery dies and you need more storage. But when you bring in new AI features, whatever they may be, we'll find out over time what kind of applications kick in. You can't run those on older phones. When we did the math when the event came out, less than 10% of the current overall install base of Apple iPhone can even run those functions right now. So you need new hardware, you need faster processor, you need more memory. That's what leads to a bigger refresh cycle.
I mean, I even got the email from Bloomberg's tech people saying, dude, you need to upgrade, because very soon you're not going to be able to run all the Bloomberg apps.
Your phone has stopped working. Thank you. Goodbye. All right, Anurag, thanks a lot. Really appreciate it. Anurag Rana, Bloomberg Intelligence technology analyst, joining us. My mother, too, like her computer, her Mac, literally just stopped working. It was like, we're done here, thanks.
Done. Yep, you're done. It's useful life.
And then we're done. Okay, let's get to another top story here that we're looking at. And that's HSBC is looking at potentially merging its commercial and investment bank to cut some costs. We wanted to get more on that with Tomasz Netzel, senior U.S. banks analyst. He joins us from Bloomberg Intelligence from London. Can you just walk me through why and sort of what this would look like?
Yes, hey guys, thank you very much for having me. So cost cutting, yes, so that's definitely something on top of agenda of the new HSBC CEO, who has just started his position a couple of days ago. So why cost cutting? First of going down the next 2 years, and the HSBC needs to do something to keep the profitability. They would love to stay at around mid-teens ROTE, and in order to achieve that, they need to cut costs because there's little options to do with revenues.
So what is the competitive position for HSBC? Just break it down for us, because I think a lot of our listeners and viewers don't have a great handle on it.
Yeah, so first of all, we need to understand that HSBC is very much heavily emerging market focused bank. If you are emerging market focused bank, of course, you have much better opportunity to grow your revenues, your growth, your lending. But if you look into the outlook, it's not such a rosy story anymore, because now we have much higher interest rates. Rates are going to go down. GDP is not so growing so fast as it was in the past. So revenue is going to flatten in the next 2-3 years. But if you are emerging market focused bank as well, you are facing higher inflation costs, and because of the higher wage inflation in those markets, etc., your cost base is growing. On top of that, you have to invest in digitalization, transformation, etc. So everybody is doing this globally. So there is massive cost pressure, and looking at HSBC, which is spread across more than 50 markets, mainly in Asia right now, after recent restructuring, there's a massive cost base, and they have to do something about this to streamline the operations. They have started this already a couple of years ago under Noel Quinn, and they've done quite a good job cutting costs by more than 5 billion. However, there's still lots of things to be done, and one of those aspects will be definitely headcounts, and then maybe looking into cost base and look at headcounts and try to have some synergies in those two businesses, which will combine have around 40 billion in revenues, will be the biggest revenue driver for HSBC, much bigger than wealth management, which is the key focus of the bank at the moment.
This might be a dumb question, but if it makes so much sense, why haven't they done it already?
Well, that's a good question for CEO who just left, so Noel Quinn, and the new guy is coming, and he has to deliver something, and he has to. Why he hadn't done it before? Because we are living in different interest rate environment, right? We are living in interest rate environment that was supporting revenues, but the conditions has changed, environment has changed. Now the expectation for U.S. rates, global rates are going up and down. The volatility is quite high, but I think we know more or less that the rates gonna come down, and HSBC is one of the most sensitive banks to cut in interest rates, so they have to do something quickly. And definitely, new CEO needs to deliver something, needs to convince market that he can get the handle on cost. Cost is definitely a big issue. We have been writing about this quite a lot. You want to deliver, if you are emerging focused bank, you want to deliver revenue minus cost growth, which we call operating jaws. You want to have at around 1 to 3%, and at the moment they are running negative jaws into the future. So it's not a compelling story for HSBC. Hence, cost focus right now is very important, and they will replicate possibly what Standard Chartered did at the beginning of the year, where they also plan to merge two units just to cut costs, and they are able to keep costs flattish in the next 2 years, and possibly HSBC is going to follow the same path.
Tomasz, I'm just looking at the PGEO function to see where they get their revenue from a geographic perspective, and again about half of their revenues comes out of Asia, about almost 40% comes out of Europe, only about 10% out of North America or so. Can they be a significantly profitable and generate the types of returns they need to without having a bigger presence in North America?
Well, if you look at HSBC, they have been very much deleveraging themselves, or they were de-risking themselves, and they exited France, Canada. They have some US as well. They are heavily focusing on Asia at the moment, and Asia growth is what they want to leverage and embark on. They definitely look into wealth management, and if you look at news stories over the Bloomberg, there's lots of stories. They're hiring more people in Hong Kong, more in Singapore, because they want to really compete with wealth management, and this is the area of their growth. And whenever they talk about interest rate or lending, growth is very difficult at the moment. So wealth management is definitely something they want to explore further, and that is the area of growth for them. It's in Asia, but also in Middle East, where we have the largest number of billionaires come to the market, and they want to definitely capture the opportunity in this area.
All right, Tomasz, thanks a lot. Tomasz Netzel joining us, senior EU banks analyst for Bloomberg Intelligence. So guess what?
What?
I watched the U.S. Open finals for women on Saturday and got
Yes.
so into it.
Yes.
And it was the first time I was so bummed I didn't have ESPN for Sunday. I was at my parents' on Saturday, so I watched it. But Sunday I couldn't watch the final. I was so distraught.
See, that it's sports. It's going to suck you
That's
in.
what I'm saying. It's
I
gonna
know.
suck me in. But I'm like, can I get it for a day? How would that work? But that's how they're going to get me.
Sabalenka.
Yeah. Oh my God. But that match was really cool. I was
a
like
great match.
yelling at the
Yep.
screen.
Yep, that was really good. It was a great match. I think it was a great 2 weeks. It's just one of the highlights for me. Watching the U.S. Open Finals, summer's over. Let's switch the gears
okay.
into football.
Okay. So
That's
this is why we have a dark suit on today.
Yes.
Yes. Okay.
Yeah, but although we were at the beach yesterday, it was fantastic. The water's still 75, which was warmer than air temperatures. It was a little chilly when you got out.
Oh, okay. Fair enough. Coming up, Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management, will be joining us for his outlook on the markets, how do you position ahead of Apple, and the CPI. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks on the rise as dip buyers show up after last week's sell-off. The S&P 500 stopped a 4-day losing streak. Buyers scooped up some bargains. Right now, we have the S&P 500 up 0.9%, 51 points. The Dow up more than 1%, 438 points. We have the NASDAQ up 1%, 167 points. The 2-year yield at 3.68%, up 2 basis points. A yield on the 10-year 3.72%, and that's up 1 basis point. To commodities, we have spot gold lower, $2,496 an ounce. We have Brent crude, $71 a barrel. WTI crude, $67 a barrel. Moving the markets, Summit Therapeutics, they're up 66%. It had the latest data, its lung cancer drug. It showed it beat Merck's Keytruda in progression-free survival. And then you have shares of Palantir Technologies, Dell Technologies, Erie Indemnity, all higher before the bell. And this is after it announced the stocks would be added to the S&P 500 before the start of trading September 23rd. It's part of its latest quarterly rebalancing. So we have Palantir up about 11%, Dell up 4%, Erie up 4%. And news surrounding HSBC. Sources say it's considering combining its commercial and its investment bank divisions. It's part of the CEO's new push to overlap its roles, to avoid overlapping roles, and also shed some expenses. We have HSBC in London up about 2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also like to take a broader view and kind of step back and look at what the pros are doing. And for that, we go to Chuck Lieberman, management. They have just under $8 billion in assets under management. Great person to talk to, Chuck. Do you care if the Fed cuts 25 or 50 at the next meeting, if they cut 75 or 50 for the rest of the year?
I do care because of the message that it sends.
Okay.
In terms of the economic impact, that's likely to be small, 25 or 50. I don't think the market is on board with what they're likely to do. I think they're going to do less rather than more. The market's priced for 125 basis points between now and the end of the year. And I just don't see that as feasible without a recession.
So we had a whole slew of economic data last week, culminating with the jobs number on Friday. It appears the economy is slowing. Is it slowing at a rate that, A, do you agree with that? And are you concerned that maybe it's slowing too much?
It is definitely slowing. But as I joked, good luck trying to avoid getting a traffic ticket if you tell the cop you slowed from you slowed down to 100 miles an hour in a 70 zone. That's not going to fly very well. The economy has slowed. We're growing at a more moderate rate, but we're still growing north of 2%. And fundamentally, that's a very solid growth rate. Productivity is adding 1.5% a year. Labor force is adding, domestic labor force is adding 0.5% a year, maybe. All of the rest is coming from immigration. And so we have the capacity to grow at 2% a year. We're doing that. So that's very solid growth.
So if we have that solid growth, is it that the Fed will cut less in the short term, but the amount of cuts overall in the cycle is the same? Or do you think that we need to start, and I mean investors, need to start paring back what they think neutral is?
Well, I think that the market has a bad sense of what neutral is. And one way to see that is people say that monetary policy is very tight. They look at the funds rate and they look at inflation and they say interest rates are high. True. If you look at the 10-year, however, relative to inflation, the real rate on the 10-year is not very high. And yet that's the rate that matters much more for corporations. It matters more for mortgage rates. It's a much more critical interest rate. And on that basis, monetary policy is not tight. It might even be considered loose.
So given that backdrop with the economy, with the Federal Reserve, where are the best opportunities these days for you? Do you find them in the equity markets, in fixed income? Are there certain sectors that screen well for you?
Fixed income is not that attractive, especially because the market is anticipating a lot more cuts than I think are likely to come. But the equity market, I think, offers good value, especially the disliked, unloved S&P 493. The Mag 7 obviously are through the roof. And I think a reasonable case can be made that justifies that. They all have high growth rates. They have enormous growth potential. Companies are typically doing very, very well. I think you can look at them, you have to look at them actually one at a time and judge their prospects. The 493 are relatively ignored. And there's great value across the board in whole sectors. So it's not hard to find stocks with good, solid prospects, good dividends, and trading at 10 times earnings or even less. So that's real value.
So, okay, so where, I guess, what spaces? Like, are you going to go like deep cyclical there? Do you just look for value? Is it dividend players? Is it going to be just safety trades in those 493?
Well, I manage a portfolio that is income oriented. We call it income with growth. So it's based income-oriented portfolio. I've got lots of exposure to the energy sector through master limited partnerships, oil and gas partnerships. I've got lots of exposure to business development companies, very high-yielding companies because they're required to pay out their profits. I've got exposure to parts of the REIT market where I think there's real value. And then there's the banking sector, the financials. The financials are typically still cheap, still offer very good dividends, and they're very well capitalized, and the companies will do well.
So you mentioned banks, financials. Do you have exposure to regional banks as well?
Yeah, a couple.
And how concerned are you about commercial real estate and the exposure there? Because I mean, Alex and I, this is something we probably try to get as many guests on as we can to talk about commercial real estate in general.
Well, there's no question that the office space market is problematical, but that's only a small fraction of the overall real estate market. I've seen numbers like 6 or 7% of the total commercial real estate market is office. The rest of it is fine. The part of the market that I really like are nursing homes. They got crushed during the pandemic for obvious reasons. The stocks are still cheap. Business is recovering, not surprisingly. Occupancy is rising, rates are rising. Their biggest problem is getting labor. Labor costs are rising, but profitability is improving. They pay high dividends, perfect for my strategy of income with growth. We're producing over 6% yields on that strategy. And we've still got some growth embedded in there as well. So it's a great way to generate income in a cheap part of the market.
So staying on that for a second with commercial real estate, aside from office, we generally hear like student housing, senior housing, and also warehousing. Is there like another leg or something to that that's also interesting to you in that space?
Well, it's all one-offs. So, for example, there's EPR Properties, which does experiential type of things. They own Top Golf outlets. They own movie theaters. The movie theater business is struggling, obviously, but it is coming back, and Top Golf and other parts are doing well. So that's an interesting play. We own it. So there are lots of opportunities. You just have to dig.
So when you talk about your dividend strategy, I guess almost by definition, you don't have a big exposure to technology. Because I look at a company today, the story today is Apple and the new phone launch, and we're covering it like crazy here at Bloomberg. But you look at this company, they got $150 billion in cash, they're gonna throw off $100 billion a year in free cash flow, no dividend.
Okay, you should know that this is a point of contention
This is a thing
for Paul.
me.
He gets very upset by this.
I argue with Tim Cook about this all the time, at Duke, usually over a cocktail. But what do you say, how do you think about the technology companies and dividend, given all the cash flow they have?
Okay, so as a fiduciary, we've got a diversified portfolio. So we have to have some exposure to technology.
Okay.
There are companies that pay dividends, and they're still doing fine. Seagate Technology is one of the ones that we own. Broadcom is another. We've owned that one for a while. These are among our lowest yielding holdings in the portfolio strategy. Nonetheless, it gives us some exposure to technology, and Broadcom is going to benefit from AI. So we're playing that game too.
And it's been one of the most undervalued plays versus like an NVIDIA. It's really underperformed from that perspective too.
Well, it's undervalued in that it hasn't performed as well as NVIDIA, but then few things have. But it's great value and will do fine. And we're long-term players. We're not trying to make the buck in the next 20 minutes.
Tax policy, it's an election year. Tax policy is going to be front and center here for both candidates. What's it mean for, again, an income investor like you?
It matters a lot. So one of the things that we look at is how is the tax treatment of the dividends that we produce. We prefer ones where there's some shelter, which MLPs do. It's great. REITs do as well. Interest is taxed at full income tax rate, so that's not as great. And equity 20% fixed. We're more like 15, closer to 15 fixed right now because we don't see the bond market as particularly attractive.
So if corporate taxes, say, are raised, does that change then the dividend payout situation that you're talking about?
It will hurt, but it will hurt everything. All stocks will be worth less because of a higher dividend, a higher tax rate. So you have to pick your poison. And the question is, which ones will be hurt the least? Again, if it's a matter of full tax applicability, like for interest, that gets hurt even more than stocks. In the case of stocks, some pay return of capital, they will be hurt the least. So yeah, it will affect some of our allocations.
When you sit down with the management teams of the companies you own, and you talked about use of cash and cash repatriation, buybacks versus dividends, what's the discussion like? What points do you make?
I love it when they do buybacks, but often they feel like they've got to do some dividends to placate shareholders. Look, however they return capital is good. If they're producing enough free cash flow that they can afford to buy back or pay out higher dividends, either one works for me. Theoretically, I shouldn't care. That's what the mathematics say. As long as they return capital, are profitable, and they're growing their earnings, and their return on capital is high, I'm happy.
If we see increase in capital gains tax, how do you think about that?
Again, that hurts. It hurts the valuation of these companies, and so, but it's an across-the-board type of damage. It will hurt the valuation of the entire stock market.
So what's the big issue that you're focusing on right now with your team?
Well, I think the issue that everyone's struggling with or talking about is whether or not the economy is likely to lapse in a recession anytime soon. I think the answer is no. When I look at the economy, I have a tough time constructing a recession scenario. The easiest way to make that case is to say that interest rates have gone up a lot, and that will cause a recession. Well, we've been sitting in that boat for a long time, and it hasn't happened. And there's a reason it hasn't happened. The consumer is in very good shape. Job growth is still solid. Income growth is even more solid. So consumers have the capacity to spend, and that's 70% of the economy. Capital investment, we're trying to promote green initiatives. We're trying to bring business back to the U.S., manufacturing back to the U.S. That's a tailwind for the economy. We happen to have a severe housing shortage. So even though mortgage rates are high, it hasn't crushed the housing market as much as it would have if we didn't have that housing shortage. And if interest rates dip, you're going to see housing take off like a banshee.
All right, great stuff. Really appreciate it. It was so good talking to you. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management, joining us there. All right, coming up, Michael Halen joins us, Bloomberg Intelligence senior restaurant and food service analyst. Oh, it's Starbucks CEO first day. Did he commute, I guess, over the weekend in the plane?
Right, on the corporate jet.
Yeah, we're going to get more detail on that, sort of what's at stake as the new CEO takes the reins. This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. All major groups in the S&P 500 bouncing back after its worst start to a September since data going back to 1953. The tech space outperforming. NVIDIA, trying to pare back some of its recent losses in its worst week in 2 years. Right now, we'll check in with NVIDIA shares. They're up about 1.5%. So let's get to the stock market. NASDAQ up 0.5%, 95 points. We have the Dow up more than 1%, 403 points. We have the S&P 500 up 0.7%, 39 points. The 2-year yield at 3.67%, up 2 basis points. A yield on the 10-year 3.72%, and that's little changed. Companies making news, Big Lots, yeah, it's official. Discount retailer filed for bankruptcy protection, plans to sell its assets, ongoing business to Nexus Capital. And today, Alphabet's Google heads back to court. It's going to face the U.S. Justice Department antitrust allegations about its ad empire. We have Alphabet down about 0.7%. Also today, you have a trial over the FTC's attempt to block Tapestry's acquisition of rival Capri. Tapestry right now up about 2%. We have Capri Holdings up about 1%. And finally, Couche-Tard told at 7 and I that it wants to work together to agree on a, quote, friendly takeover. We have Couche-Tard up about 0.3%, 7 and I up about 2.5% in Japan. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. So one stock we're watching today that's doing absolutely nothing is Starbucks, trading at $91.16. It's literally flat on the day, but it's a big day because incoming Chief Executive Officer Brian Niccol has to live up to the hype that really propelled Cheryl's hire. It's his first day as CEO of Starbucks. Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst, is joining us now. First of all, how long do you think the market gives him before they judge him?
Yeah, it's tough to say, right? I think really it's going to take some time. You don't turn around an aircraft carrier on a dime. Starbucks is a behemoth of a company. So I think the market gives him some time. He's got a phenomenal track record, right? What he's done at Taco Bell and then Chipotle, obviously, were very impressive. And he's really, the first thing he's going to do, I think, is just try to change that culture, right? Bring in a culture of transparency, accountability. He's going to talk about hard work and compensating his employees for doing a good job, because those are some of the things he talked about changing at Chipotle on his first earnings call there. So all that stuff's going to take a little bit of time, and because of his track record, he'll get a pretty long leash, I think.
What are the challenges facing this company? Because just as a consumer, I mean, the Starbucks on Route 35 in Wall Township, New Jersey, they do a great job. People are great. It just works like a charm. Store's in great shape. The one in Summit's good. It's always packed. What do they need to do here? I don't think anything's broken.
Well, it depends on the store. It sounds like that location is doing pretty well, but they have thousands and thousands of locations across the globe. I mean, in the U.S., operations is a big issue. Drink orders have become more complicated. Digital orders have kind of changed the experience for the in-cafe customer, right? Like it became popular because the baristas knew your name, right? And the level of service was phenomenal for a chain of that size, right? And through digital ordering and these very complicated orders, right? And so operations, they're losing a lot of orders because people are trying to place them on the app, and the wait times are kind of obnoxious at times, right? And so I think operations is going to be his primary focus. Running the best cafes possible is really going to be job number one. But there's a bunch of different issues. Operations is just one of them. Politics has been an issue, right? Starbucks has always been a brand that kind of puts their politics in your face, and I think Brian Niccol is going to want to step back from that, right? Because of all of the all the issues they've had with their customer base, right? People haven't been happy with, there's been some boycott talks online about their stance on the Israel-Hamas war, about their stance and how they've handled the union negotiations, so that's a big thing. And then, we think eventually, once they have the stores running really, really well, they're going to start spending some more money on marketing. Maybe not a ton of money, but we would expect them to start spending on marketing. It's not something that Starbucks has traditionally done, but it also wasn't something that Chipotle had traditionally done, and it's been paying them dividends now for a handful of years.
So the thing with Chipotle, though, we just and maybe Paul can attest, is that like there's a menu and it's basic, like there are add-ons, right? But like it's a basic menu. Starbucks menu is like explosive. Like they can't even have all the options up on the ordering board because there are just too many. So does working with operations and getting that better mean they have to pare back their menu and get back to their base?
Yeah, probably. We had been critical of the previous management team because they kept rolling out new menu platforms, and then in the next breath talking about improving throughput. Well, you can't have both. So we fully expect them to pare back this menu, make it easier to execute in the cafes, right? Make lives easier for their employees and get the orders out faster. So yeah, I think that's going to be a major part of what they do going forward.
I mean, Bloomberg had a story from in 2023 where, I mean, the variations, if you add up all the potential options, there's like billions of different types of drinks that can be made.
Oh, yeah.
So it's just out of
And there's like the cold drink, there's the tea, there's the refreshers, then there's the frozen refreshers, and the blended refreshers. And I know that's because my daughter likes those things.
Yep.
But sometimes you get them frozen, and sometimes they're not. It's very complicated.
I know. I don't know how they do it. My power, my hats off to them. All right, let's step back and look at the restaurant space in general here. You've got some research out recently, restaurant promotions, marketing heat up. That's not what shareholders want to hear, do they?
No, but restaurants are kind of desperate right now to get some traffic into their stores. Low-income consumers' spending has been very weak. This seems to be spreading to the middle-income consumers, right, based on the industry data that we've seen, which showed an improvement last month in August, but it was still negative at casual dining restaurants, at family dining restaurants, and at quick service, right? And so they bounced from that horrific July numbers that we saw, but still are negative. And so, yeah, restaurants are trying to do whatever they can to bring, those low-income consumers and middle-income consumers back into their restaurants. Just for example, it was, I think it's 35 out of the last 37 quarters quick service chains have had negative traffic, right? And so that's not a sustainable type of situation when you have same-store sales rising because your prices are going up, but traffic continues to decline. Eventually, there's a tipping point, and that's what we've seen this year.
So to that point then, which ones do you have faith that can maintain some kind of margin and also grow their top line?
It's some of these chains that have a big pricing less than their competitors, right? So if you're providing a lot of value, and value can be two ways. It can be a better price, but it also can be a lot more food for what you pay. But some of these companies that people see value at, Wingstop, Chipotle, Texas Roadhouse. These are all of the chains that have been outperforming. These are all of the chains that have been able to drive traffic, and a big part of it is being priced below competitors. Wingstop's raised prices about half as much as their competitors, and on their last earnings call, they credited that as a big reason for their phenomenal quarter.
All right, Michael Halen, thank you so much for joining us. Mike Halen, he's a senior restaurant and food service analyst, Bloomberg Intelligence, joining us from Princeton. Talk a little Starbucks, first day for the new CEO there. I'm happy with my Starbucks.
You don't drink Starbucks?
I go like once a week.
Oh, okay.
I used to go more often, but double short mocha, very easy. What's your go-to?
Oh, yeah, okay. It is an Americano, sometimes ice, sometimes not, half calf, almond milk, 2 stevia.
Wow.
Which actually, for a Starbucks order, isn't really that bad.
Yes, that's not.
Like, there's no syrup, there's no whippy things. It's
Okay, I think the younger you are, the more creative you are with your coffee orders.
Why, thank you.
I'm just
so
saying.
Sweet.
I mean, and some of the kids come out with these things. I'm like, how many derivatives of a basic cup of coffee can you have there? But apparently there's a lot. But again, Starbucks. Who knew? This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence analysts because they cover 2,000 companies in 130 industries all around the world. They truly are the best out there. Joining us now in studio is Mandeep Singh. He is Bloomberg Intelligence Senior Technology Analyst. And there's lots to talk about with Apple, but we're going to start on Google. So Google is heading back to court on Monday. It's going to face the DOJ and the allegations that it manipulated the $677 billion display advertising market in violation of antitrust laws. How much should I be paying attention to this? And I say that because they get called all the time to court, right?
I know, and I've started to lose track of how many lawsuits are pending against them. So this one, I think, is not that serious, at least in the scheme of, the other lawsuits, the monopoly lawsuit that they lost, and the Google Store lawsuit when it comes to, how they charge a higher take rate. So, I mean, look, Google has built this ad stack, the fact that they control the sell-side inventory, the buy-side inventory, and they're a market maker when it comes to the digital ads. So owning all the three parts of the stack, you could say, yeah, it's, they could manipulate it, but the fact that they have built this over a span of 20 plus years, it's hard to say which part is really being manipulated, and that's why I feel this is probably the weakest out of the courts, although out of the trials they're going through in the courts. But I would say yes, it will prevent them from probably making any other acquisition or doing anything in terms of increasing their moat in the ad stack that they already have. But the system that they've created when it comes to digital ads.
Thank you. You're welcome. You were just assuming I wasn't going to do my job correctly, which is a fair assumption.
You started talking.
At least I stayed here. I didn't walk away in the middle of it. Which
Yeah.
That's been known to happen today.
Although I also didn't
Covered
turn
for
on
me.
my mic, so whatever. We're good. We're good with you, Mandeep. We're here.
My response, if I were Google, would just be one word: Amazon. In the midst of this environment where you're saying I'm monopolist, Amazon has just built this gargantuan ad business.
Yeah.
This is a competitive business. Oh, by the way, there's the Facebook people out there as well as all the other competitors. Is that a viable response that, hey, I'm not a monopolist because this is a very competitive market?
Yeah, and look, I think when it comes to the monopoly side and whatever changes they have to make when it comes to, the fact that they lost this case and they will have to make a few accommodations, I feel the digital ad market has gotten a lot more competitive, partly because Amazon is there and it's a very formidable business, $50 billion run rate business. And you have competition from the likes of OpenAI and, the competitors that are building search based on LLMs. So it's hard to really make a case that this is a monopoly. There is no other place to go. And, all the smaller companies are not able to grow because digital, Google is still dominating the digital ads market. And search engine optimization is still the way small businesses think about, spending their ad dollars. And the fact that Google is so good when it comes to the ROI on ad spend is just a function of the systems they have built over the last 20 plus years.
It's like, well, they're good at it, so therefore they keep doing it and people like it. It's like, it's the same argument with like an iPhone, right?
Yeah.
It gets confusing.
Yeah, because I just think that some of these antitrust suits that are focusing on technology, if you talk to the average person on the street, they're like, no,
They don't
I don't do anything here. I like my iPhone. I like my search thing.
Right.
I like
if
my
you make my job
shopping.
more complicated, doesn't
Yeah.
that stink? And in which case, why are you doing this to me?
Right. I like to click a button and buy stuff.
The one thing they will have to change is the default payments. So the fact that Google was paying Apple $20 billion a year for the distribution, I think that's why they lost the monopoly case, and that is where the remedy will come is Apple has to make it more open in terms of anybody can bid to be the default search, and that's where the Apple's 20 billion revenue stream will come into play. Like that's pure gross profit for them.
Yeah.
And,
but I think Google, I'll write that check any day of the week to get that distribution.
But how bad will it be if they don't get to write that check anymore and have the distribution?
Well, who's going to outbid Google to get search
That's a good point.
display on
I mean,
Apple?
Microsoft has tried in the past. It hasn't worked
okay.
for them because their product is inferior. The
Yes.
search product is inferior. And that's the biggest problem I think the courts, the regulators have had is why are you paying to be the default search? Why can't there be more inclusive process in terms of having competitors bid out? But like Paul said, probably Google will still be the highest bidder. Who will outbid Google when it comes to the $20 billion stream?
That's a real head scratcher.
It is.
I gotta be honest.
There's some big numbers out there.
Yeah.
I mean, this business. What else are we looking at?
Apple, I mean, look, Apple Intelligence is a big, big deal when it comes to the fact that Google is paying $20 billion for that real estate. And if Apple launches a really good system where they can enhance Siri, I mean, to me, that is the driver of, Siri, nobody uses it, you turn it off. But that's the real estate that they gotta use. And the biggest use case of AI is me being able to talk to the phone. Like, I really like Meta glasses right now because of the fact that you can do things in a very seamless way, even though it's one or two functions. But to me, that's a real threat for Apple. If you ask me, like, if Meta AR glasses becomes an AI assistant, that's a huge threat for Apple.
And there's a lot of stuff going on there. You're going to keep your job for a while because we need people like you. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, along with Anurag Rana, my personal iPhone shopper. They're getting me all fired up for this new iPhone.
Are you gonna get a certain color, or
I don't know. I don't know.
They always have different colors.
Do they? Okay.
Yeah.
I got to get it. Yeah,
I have
we'll see.
lavender, I think. Yes, I do. Lavender.
Yeah, I'm going to steer away from the lavender. All right, S&P 500 up 0.6%. The NASDAQ up about 0.3%. Screen on the screen here. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence folks. We got a bunch of them lined up for you. George Ferguson will join us in just a moment. Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst on Boeing's deal with the unions. Plus, Mark Gurman, Bloomberg Chief Correspondent on Global Technology, will dive deep in today's Glow Time event from Apple. Plus, Carol Pepper, founder and CEO at Pepper International, joins to discuss her outlook for the markets. But first, let's kick it all off with a business flash. Here is Charlie Pellet.
All right,
Charlie?
thank you very much. And Alex, you mentioned Boeing up 3.1%. You also mentioned Apple. Apple down 1.6%. This update brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. S&P now higher by 32. Bounce back Monday up 0.6% after last week's rout. The S&P now at 5440. We've got the Dow up 367, higher by 0.9%. Nasdaq is up 60 now, a gain of just about 0.4%, while the 10-year 3.70% and the 2-year 3.66%. Spot gold, little change, down 88 cents right now at 24.96 the ounce, down less than 0.1%. And West Texas Intermediate crude up 1.2%, 68.51 a barrel on WTI. Bottom line here, a renewed wave of dip buying is spurring a rebound in stocks after last week's sell-off triggered by economic concerns. As we have been reporting, it is a big day that has taken place today in Cupertino. Apple shares down now by 1.5%. So again, recapping, stocks higher, S&P up 32, a gain of 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Really appreciate it. Charlie Pellet, Alex Steele, and Paul Sweeney, all here on this Monday. So let's take a look at Boeing for a second. You're looking at that stock up by 3%.
Yep.
But I wonder, I think the union vote's still going to go on. This just means the union agreed to it, but everyone's supposed to vote on it. So I wonder how much risk there still is.
I know. I mean, the shares rallied here on optimism that a labor deal with its largest union will help the troubled U.S. aircraft and manufacturer avoid a potentially crippling strike. And I'm guessing the leverage was with the labor union, because the last thing Boeing wants, in addition to all the other issues they have, is problems there. But let's break it down with George Ferguson, Senior Aerospace Defense Analyst at Bloomberg Intelligence, joining us from Princeton. So, George, how big of an issue is this? It appears that they're going to avert a strike here. How important is that for Boeing at this stage?
Yeah, so I think it's super important, right? So Boeing burned a lot of cash in the first half, about $9 billion. When we look at the free cash flow line, they can't afford to keep doing that, right? The company is a little bit over $10 billion of cash in the balance sheet. We think they need about 10.9-ish to operate the company. Everything is really predicated on a lot of deliveries in the back half. Inventory is built to over $80 billion at this company. It's about twice what Airbus's inventory is. So they've been bringing in products and components from suppliers, trying to keep their suppliers going, right? Because they need to keep them healthy as they fix their production problems. They're really hoping to deliver a lot of airplanes in the back half and start to unwind that inventory and build some cash. And so without workers, can't get that done, right? And so that's why this is super important to Boeing's back half recovery.
Now, from what I understand, it's 25% pay increases, right? But didn't they want 40%? So are union workers actually going to vote for this?
Yeah, so the union came in at 40% as their starting point. I mean, 25% I think is the increase that's on the table without, Boeing had some mumbo jumbo in there about, I think some structural components of worker pay that would have turned it into 33%. They also get a $3,000 bonus to sign. And so it's not just 25%, but I mean, 25% seems near where we've seen at, other wage agreements, 25 to 30% near where we've seen other wage agreements in the economy. I feel like maybe sort of labor's strength is diminishing a bit. Boeing for sure needs the agreement, so they're probably the weaker position here. But it does seem like labor costs starting to come down, and some of labor's strength has been ebbing a little bit in the U.S. economy.
And what I also saw, which this I thought was very important as well, is that Boeing agreed that to build its next plane in this Seattle area.
Puget Sound.
Yeah. Why is that important?
Well, I mean, so that is, the long-term health of this union, right? If you're the machinist, you want to have workers on the flagship programs. And so if Boeing decides to announce a new airplane in the term of this contract only, that's what the agreement is, right? It's for the 4 years of this contract that they decide they need a new airplane. They've agreed to build it in the Puget Sound, which keeps machinists working on it. I frankly think there's probably a pretty strong potential they do that. I think they need a replacement for the 737 to make it more competitive. I think their engineers need to flex their engineering muscles. I think Boeing needs to show, I guess just their earnestness inside this industry to create world-leading products. So I think there's a high probability that they get that, and there's nothing to say the machinist can't come back for a similar clause in whatever follow-up contract comes as well.
So is Wednesday no longer a risk event?
No. The rank and file have to approve this agreement. And it's not unprecedented that a rank and file can go against the recommendations of their leadership, but their leadership have, essentially agreed to this deal with Boeing management, and now they present it to the workers and ask them to vote on it and ask them to approve it.
George, what's the latest on, manufacturing, getting those orders out the door? Where are we today? Where would they like to get to in terms of deliveries?
Yeah, so I mean, that's a big question, is where are we today? I don't know that we've seen a stabilized build rate out of Boeing that we could say we're at. What I hear is suppliers are building in the 30s range. And so where do we want to go? Boeing wants to go, or where do they want to go? They want to go to 38 by year end. Again, I think a walkout would really a strike would really put a huge dent in the plans to get to 38. Around 38, the cash performance of this company will be a lot better. The profitability performance of this company will be a lot better. So that's where they want to go to. Again, a lot riding on this agreement.
So do you think that Boeing has a good case, though, in terms of the stock for sort of marching its way higher here? Like, is all the bad news done? I hate asking that question.
I mean, look, I don't think there's still challenges in this business, right? I think if they were to get this agreement, at least we have workers on the line actively working to deliver airplanes to customers. If the rank and file is generally happy with the agreement, I think that's definitely a positive on the manufacturing floor. But look, we saw Airbus, they delivered 36 A320s in August. It was okay. That was it's a summer month. Everyone in France is trying to take a vacation. It's less than the year prior. We were kind of expecting Airbus to be moving to higher rates now. They've told us they're having problems with suppliers. We know the engines are a problem. So I would say, look, getting the agreement, fixes a big obstacle because, again, can't deliver anything without workers. But the supply chain still has its challenges. And so it's not a given that if they get this agreement that they'll be at 38 at the end of the year and cash flow will flow. But it will be certainly better than if they've gone through a strike.
All right, George, thanks so much for joining us. Really appreciate it. George Ferguson, he's a senior aerospace and airline analyst for Bloomberg Intelligence. All right, so we know a big day out in the Bay Area today with Apple and their new iPhone and new product launches, but it's also an important day coming up in a couple of days for our listeners in San Francisco. Starting our business app It works seamlessly in your car with Apple CarPlay and Android Auto. Make the switch today because October 1st, Bloomberg Radio is streaming directly to your phone. The Bay Area's new home for Bloomberg Radio is the Bloomberg Business app. Download it free at the Apple App Store or on Google Play. But I'm guessing most of the folks out in the Bay Area kind of already do that because they're supposedly
cool there.
pretty cool people.
Yeah.
Anyway, so speaking of cool people, Mark Gurman, he covers all the technology stuff out there for Bloomberg News. He's out there, presumably in Cupertino or on his way. Mark, I've already informed Tim Cook that I am, in fact, going to be upgrading my phone here in the not-too-distant future to the iPhone 16. I guess I am. Who cares? And they're very excited. Are people excited for this event here today? And if so, why?
I'm not in Cupertino. I am actually in Los Angeles. They are not having me at the event per usual. In terms of the launches, yes, it's all about the iPhone this year. This is actually going to be more of a muted release, right? So this is not a big year-over-year overhaul. Remember last year they added the titanium shell. This year is more about refinements, increased processing performance to better support artificial intelligence, improved displays on the Pro model, so slightly bigger screens is about a 5% display increase. But because the bezels around the display are smaller, that increase is actually going to be more noticeable than a 5% increase would normally suggest if you heard that. The other big enhancement is going to be a camera button. This is going to be on all 4 new models, both the low-end and the high-end models, and it basically works the same as a DSLR button, right? So you soft touch it to autofocus on a subject, you press it in order to actually take that photo or a video. You're also going to be able to swipe on it up and down or left to right in order to zoom in and out of a subject. So it's essentially the same camera controls that you had on the display, now relegated to a hardware button on the side of the phone. And the bet there is that will help people take more pictures and maybe better pictures, which of course is going to translate to people needing to buy iPhones with more storage space, which obviously costs more, and bigger iCloud storage plans, which obviously will generate more revenue for Apple on both of those things, right? So it's, I guess, a win for consumers and a double win for Apple.
Does that imply then a super cycle definitely taking hold in 24, 25?
There's no iPhone supercycle. There have been some analyst claims over the last several weeks about a supercycle coming with these new iPhones. I would have to say that they're either making things up or getting bad information or just trying to pump the stock price for their own, self-interest, right? The reality is that the numbers that we're seeing in terms of iPhone orders from the supply chain probably indicate an annual decline on iPhone unit shipments. Now, an annual decline doesn't necessarily mean a revenue decline, right? Because they're adding new features for these higher end models, particularly making the lower end Pro model even better at that $1,000 price point, you may be seeing people who normally would buy the $799 version go to the $999 version, which could raise overall ASPs. In terms of an iPhone supercycle, that normally means big hardware changes. We're not getting that this time around. It also would mean that Apple Intelligence would be ready to go. But I would say it's half-baked if even that. A lot of the new features aren't coming until December, and many more aren't coming until the middle of next year. So if you're anticipating an iPhone supercycle, if you believe there will ever be an iPhone supercycle again, I would say adjust your expectations for 2024, maybe focus on September 2025 when the iPhone 17 launches with more significant enhancements.
What is Apple Intelligence?
Apple Intelligence is artificial intelligence for Apple customers, right? So that's the Apple branded version of their AI platform coming as part of iOS 18.1 sometime in October. That's including summaries of notifications, that's transcriptions and voice memos, is including voice recording in the Notes app. It's including Genmojis, which uses artificial intelligence to create your own emoji characters.
Which, side note, my daughter loves that, by the way. Like, they're making her own emojis. Like, she takes my phone and does the things, and she makes GIFs and all this stuff. Like, the young kids, they love it.
I think the Genmojis are going to be incredibly popular. I think it's going to be at the center of many of Apple's advertisements for these features, but that's not coming until December. So I'm not sure how that can sell new iPhones in September if it's not going to be available until December. So I have some big questions about where analysts get their information from, why they say the things they do, and why some of them are considered reputable. So I think that people need to be able to separate the signal from the noise. And that's why I'm so happy to come on here and explain and provide a dose of reality.
So, but the dumb question. So Paul gets his new phone in October. Can he just update the stuff when the cool things like the emoji stuff comes out?
Yes, he can, absolutely. And it's not a dumb question, right? So what we're going to see are Apple Intelligence features rolling out probably over the course of the next 6 to 9 months with constant software updates. Now, this is new for Apple. This is not something they've done in the past. Usually you get one big software update every September and you're pretty much set, say for bug fixes and maybe a couple enhancements here or there until the following September. This time around, it's going to be a gradual release. Now, why are they doing that? Because Apple Intelligence simply is not ready. There's a lot of testing that needs to go into this. And the reason Apple Intelligence has been behind is because they're responding late to this AI craze. They really didn't start getting to work on these AI enhancements until the second half of 2022, after they saw ChatGPT launch, right? This was really something that was developed over the course of 2023 and into the first half of 2024. And their development cycles for major new initiatives like this, these normally can take 3 to 4 years, right? But they did it basically in half the time.
So, yeah, you raised a good point earlier, Mark, that there's a reasonable scenario, just given the size of the market, that there really are no super cycles, unlikely to be a super cycle again for the Apple iPhone. Is that a belief that's widely held out there?
It's widely held by me, and I think it's widely held by people who really understand this stuff. You know, 10 years ago with the release of the iPhone 6 and 6 Plus. 2 reasons. That was the first time that they made substantial screen size increases to the iPhone. That was your first Apple phablet, right? Moving to the 4.7, 5.5 inch screen sizes, massive. Also, that was the same year where they struck the carrier agreement with China Mobile in China, the biggest wireless carrier in the world, adding an additional addressable market of 1 billion people, right? So that is what really elicited that super cycle. And that was a 2-3 year thing. So that was great for Apple. We saw another big bounce in 2017 with the iPhone 10. Obviously, that was major in terms of ASPs, raising the starting price, right, by $300 from $700 to $1,000. That was a big upgrade with Face ID. Then we saw that again with the iPhone 12 5G, all 4 models at the tail end of 2020, at the top of COVID, when people were splurging on money, right? So that was a big one. But since the iPhone 12 in 2020 and the advent of 5G for Apple, we haven't seen major significant changes. Maybe they're coming at the end of next year. Maybe that will create a super cycle.
Yeah.
But I want people to know, don't expect one this year.
All right, we're going to talk more Apple in just a moment. Also, hey, Mark Gurman, thanks a lot. Really appreciate it. Bloomberg Technology senior reporter joining us from California. Coming up, Carol Pepper, founder and CEO of Pepper International, will be joining us for her take on the market. And continuing that Apple theme, Austin Carr, as Bloomberg News technology reporter, had a great big take story out about Apple's rise from rebel to a $3.4 trillion world power. We're going to break down what all of that means right after the break.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
On Wall Street, we do check markets all day long here at Bloomberg. We have got stocks off session highs, but still gains for the Dow, the S&P, NASDAQ, the NASDAQ 100 index on this back-to-work Monday. A renewed wave of dip buying spurred a rebound in stocks after a sell-off triggered by economic concerns. Traders now looking to this week's inflation data for clues about the size of Federal Reserve rate cuts. Wednesday, we get the CPI report. Right now, all major groups in the S&P 500 are advancing, with the S&P up 29, a gain of 0.5%. The Dow's up 347, up 0.9%. NASDAQ up 55, a gain of 0.3%. 10-year yield 3.70%, with a 2-year that's yielding 3.66%. Spot gold down $2.50 the ounce to $24.94, down 0.1%. West Texas Intermediate crude oil $68 even, up by 0.5%. As we heard from our George Ferguson, Boeing shares are rallying on optimism that a labor deal with its largest union will help the troubled U.S. aircraft manufacturer avoid a potentially crippling strike at its Seattle area factories. The two sides say the landmark offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in the Seattle area. Boeing shares up now by 3.3%. Recapping, stocks are higher with the S&P up 30, up by 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that very much. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming via YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Looking at the VIX in honor of our good friend Tom Keene, it's 21, just a little bit above 21. Anything above 20 tends to get traders' attention here, a little bit of volatility. We saw that certainly with the sell-off last Friday, bouncing back a little bit here today. Carol Pepper joins us. She's the founder and CEO of Pepper International, joining us via Zoom. Carol, what did you make of the labor data last Friday and the market's reaction to that data?
I thought it was a bit overblown. I thought, again, they're just very nervous Nellies. Rather than focusing on the fact that this would support the Fed rate cut, they were starting to get nervous about the economy. And I think actually it was a little bit of an overreaction, a knee-jerk reaction. And that's why we're seeing today the market coming back and a little bit of dip buying, because that bad news was actually good news. That bad news meant that it was more likely the Fed is going to power ahead and do the cuts and stop waffling on when to cut. So to me, it was good news. And it's just an opportunity to get into some names perhaps that you were underrepresented down right now. So but nothing terrible.
All right. So, I mean, I guess one of the questions that that data point, I guess, raised or just kind of drove home for a lot of people was, is the Fed late? Is this economy already rolling over? And will the Fed be too late to the party? How do you think about that?
No, I don't think the Fed is too late. I think it would have been nice if the Fed had cut last month, but I don't think they're too late. The good thing about the Fed is they have told us every step of the way what they're doing. They said, we're watching data. We're not going to cut until we're sure about the data. Now they've been telegraphing all month. We feel better about the data. So they're not too late at all. I mean, what we're going to see is another rally starting up once they cut and once businesses are really reassured that, you know, they're not going to go back up again. So I think actually they're right on time. It would have been nice if we had it a little earlier, of course, but it's fine because it signals that they still think the economy is strong enough to manage what's going on. And as you know, I manage money for family offices and people with over $100 million, and we're always looking at long-term trends. And that's what the Fed is trying to do as well. They're trying to make a long-term play. Mm-hmm. They're trying to make sure that they are not too hot and not too cold, get into that Goldilocks space, and that's what they're trying to do.
Well, and that's the great point, too. So I'm curiously more interested in now how many cuts they have in this cycle versus whether or not the first one's going to be 25 or 50. Has that at all changed, and is that something we should be paying attention to?
No, I don't think it actually has changed. I mean, will it be 25 or 50? I don't really know. I don't know which it'll be.
Right, but then does it? So then, when you look at the longer term outlook for all the cuts, neutral is neutral at 4%. Is neutral have a 2 handle? Does neutral have a 3 handle?
It's really hard to say at this point. I think we just have to wait and see how the market behaves. I really can't call that one.
One thing I know you can call and you have thoughts on is NVIDIA. So we've had the stock pull back pretty substantially off the highs here. What do you think is driving it? And what's your call here?
Carol?
Oh, I think we lost her. We lost her. It's all right. It's a technology thing, it happens.
It does happen.
It does happen.
It does definitely happen. But
it's not going to happen when I get my new iPhone 16 Pro or whatever. I don't know.
Is it called iPhone 16 Pro? Is that
I think that's what Anurag told me to get.
Okay.
And I've been following his call there for a while.
All right. Well, we look forward to that day when we do that. But I think also the idea is like if you're looking at the longer